we're gonna, hey, Dr. Cook and Dr. Godby, you can just come on down if you'd like now.
Oh, okay.
As we get started. So good morning, everyone. Welcome to your Joint Revenue Committee July meeting here in Cheyenne, Wyoming. Welcome to, I guess, my greater district. Are we not in your district either, Senator Ellis, are we? But at least it's nice to have a meeting in my hometown once in a while. A couple months a year. A couple of announcements. We are live streaming, correct, and up and going. So keep in mind, conversations, actions, motions will be recorded for the internet for all time. With that, let's call the roll and get going.
Senator Baldwin.
Here.
Senator Biden. Here. Senator Driscoll.
Here.
Senator Ellis.
Present.
Representative Blackburn. Here. Representative Connolly.
Here.
Representative Dayton Selman.
Here.
Representative Hallinan.
Here.
Representative Larson.
Here.
Representative Roscoe.
Here.
Representative Sweeney.
Here.
Representative Western.
Excused.
Co-chairman Case.
Present.
Co-chairman Zwanitzer.
Here.
We have a forum.
Excellent. In committee, Representative Western is a little late getting out of Sheridan this morning, but he told me he'd be here by 10:30. If you're missing him, he is coming. Josh, do we have minutes from the last meeting that were distributed? I'm not sure I remember seeing them. Are they still being? Anybody else remember seeing minutes from our main meeting?
So, Mr. Chairman, apparently our minutes system is broken. So we've been having some technical issues. We're going to a new system in SharePoint. So they are drafted. I don't know if that makes sense to you as chairman or not, but anyway, they are out there somewhere, but maybe not available to the public.
All right, so maybe committee will just hold off on approving both sets of minutes until our September meeting.
Or maybe we can get them by tomorrow, Mr. Chairman.
If you can get them by tomorrow.
Get a hard copy of them, sure.
That might be better.
That'll work. And with that committee, we have scheduled our September meeting for Pinedale in Representative Roscoe's district, who has graciously agreed to do something fun and exciting for us. So we'll look forward to visiting there in September. With that, we did not have a microphone system, so talk loud so members of the public can hear us. If no one else has any starting business, we're going to move right into our first thing on our agenda, wind tax policy. And so Dr. Cook and Dr. Godby, welcome from UW, back again to revenue here in Cheyenne, shorter drive than Lander. And you have presented the committee, I hope you all, it's online committee, otherwise it was in your packet sent, that the Center for Energy Economics and Public Policy at UW had the presentation, and I'm guessing you're walking us through that this morning.
That's right.
Okay, well, welcome, I'll let you have the floor.
Thank you. So thank you, Chairman Zwanitzer and Case and members of the committee. So this is a follow-up to the presentation that we have is actually a combination of a set of policy papers that we've worked on. So you will see a little bit at the beginning that the paper itself, which you have, is rather long, I know. So we'll take you kind of through the background of why this paper was written. It's actually the bookend to a previous paper that tried to identify what the potential costs and benefits are of changing wind taxes in Wyoming. So myself and Dr. Cook will walk you through this, and then hopefully we can answer questions. If you do have questions in the middle, I don't know how you prefer to do this, Mr. Chairman, but if people do have questions
We'll stop
through, glad to answer them.
Okay.
So,
Can we turn the lights down a little bit if that's a possibility? I don't know where the lights are on the wall, but maybe as we get going, if that's possible. Committee, if I can't see in the dark, just yell out, Mr. Chairman, we'll make it work. All right, go ahead, Dr. Godby.
great, thank you. So, I'll just make the clicker work. Do I point this in any particular direction?
I pointed it at the screen and
That wasn't me, was it? Oh, there we go. Okay. All right, so quickly, we assume, I'll take you through some of these slides. The clicker is not working very fast, so we'll live with it, I guess. This might take a little longer than we want. So the background, obviously you're all aware of it. We use a $5 megawatt hour tax just in this presentation. Previous reports have looked at what the increments would do from, say, in $1 increments, taking our $1 production tax from $1 to $5 in $1 increments. Those are in previous reports we've written. We can talk about them if you like. Quick background, as you all know, the fact that we've had this debate for quite a while has been costly to the state, but we're uncertain what that cost has been. We do know in talking to developers that uncertainty is affecting development decisions, or at least planning decisions in the future. There are some concerns that we have with respect to that development, which are pretty obvious. Clearly in the Endow report, wind was identified as a potential source of economic diversification and a strategy. If we affect development, then we could affect future revenues and also the economic benefits to the state. So I will try to. All right, so what we kind of frame this as is a trade-off. Obviously, if you tax a sector, you will affect their decisions to operate. If you tax a sector, then we could have reduced business activity, which could result in less taxes. And in a worst case scenario, you could actually affect development such that the increases in revenues from increased taxes are actually offset by either the loss of economic activity or even tax revenues themselves. You could drive the economic activity down to a point where tax revenues actually fall. So we are trying to figure out whether that's possible. And we will not be able to come up with an answer, but what we will show you is the tax sensitivity, cost sensitivity to taxes. But a little bit of background. This could take a while. Is there we go. So basically, what we've been asking is, we don't know the answers to these questions, but how sensitive is this sector to higher taxation? And where might this sector kind of leak to, if you want to think of it that way, if taxes are changed in Wyoming? That's really the question that determines whether it's sensitive or not. And we just mentioned that if you think of tax policy decades ago, if you look at the Powder River Basin and why it has developed the way it has, with about 90% of production being in Wyoming and about 10% in Montana, it goes back to taxes, and at one time Montana having higher taxes than we did. So that's a useful, possibly a useful example. And can we go to the next slide? It's possible to flip that ahead.
You're talking about the slide god?
Yeah, hopefully there's somebody somewhere who knows how to make this work.
I'll run back and switch it.
That'd be great, thank you.
This is pretty technical.
It's always technology that lets you down, right? All right, so a little bit of background that you need to know if we're going to define where the market is. There are 3 grids in the United States, if you didn't know this: the East, the West, and Texas, because they're Texas. And the circles here represent the points where power can flow between East and West. And the point of this slide is to say that the Western grid is really a separate grid. Those circles represent where power could flow from, say, Montana or Wyoming to eastern states. They're very limited. 200 to 300 megawatts are typically the capacity of those bridges, which is smaller than, say, most coal-fired power plants. So for that reason, anything to the west of those circles is in the Western grid, or can be. And so effectively, the limit of the Western grid and the limit of the market we're talking about are the 4 states, north to south: Montana, Wyoming, Colorado, and New Mexico. These are the 4 states that we'll see are the most important. Montana and New Mexico can actually send power east or west, depending on which power lines they use. Some changes that have occurred in the Western grid are in New Mexico. They are working on a 3,000 megawatt transmission line to take power out of eastern New Mexico towards California.
And Dr. Godby, if I could stop for just a second, Representative Connolly?
Yeah, thank
Sure.
you, Mr. Chairman. Dr. Godby, that the reality that we're in the Western grid seems to be a enormous assumption in everything that you and other people write. And I am curious about that. And now you mentioned that Montana can go east as well. So I'm curious if there can be a change so that we can move our power both west and east without taking that assumption as the be-all and end-all.
Dr. Godby?
Yes. So the question is, can we move power east out of the Western grid? The answer is yes, but it's really expensive. So the difference between the Eastern and Western grid is really a technical one about the phase of the electricity. The technology is exactly the same. You have to build expensive plants, or you build a plant in Eastern Wyoming, for example, that can never really interface with the Western grid. So the Laramie River coal station actually has a generator that sits on the ground next to the other two, but is electrically isolated. And it is that generator, even though it's sitting next to the other two, is in the Eastern grid. So to answer your question, it is very expensive to move power across that because you basically have to convert the AC to DC and then back to AC. And they have those stations, they're expensive. How a plant in Montana accesses the east or the west is just what infrastructure they connect to. So the underlying highway of transmission lines basically hits a gate at wherever it interfaces with the eastern grid, if you're in the western grid. And so to get past that, you basically need to build much more infrastructure to get around it. So if you think of it as a road system, the road pinches down to a really narrow 2-lane road, so you funnel everything through what amounts to a roadblock. So to go to the eastern grid, you would need to develop that technology. It can be done. It's expensive. What plants want to do is build without building transmission. And so that's been a problem in Wyoming for developing wind, but it's changing significantly now as coal plants ramp down. We can actually use the capacity that they used to use up. And in Montana, the majority of the electrical capacity is westward now, especially with the pending closure of the Colstrip, Montana coal generation facility. There's actually a rush right now to see if people can get those transmission rights, but the power goes west. So even though you're in eastern Montana, that power goes west. And we'll talk more about this, but because the two grids are isolated, we can't send power, for example, to Nebraska very easily. We either have to build a plant that will never serve Wyoming and is just isolated as if it's in Nebraska, or we have to build a conversion station, which is very expensive and limited in its capacity in order to get there. Does that answer your question?
Thank you, Mr. Chair. Just a quick follow-up. Are you familiar with any company that's attempting to blow up what you call that roadblock?
Yes. There is actually several companies and a national initiative to build a very large DC direct current transmission system that would actually loop the United States. And the sole purpose of that is to link, well, the largest purpose of that, or the greatest importance, is to link the renewable centers around the country to maximize diversity. When people are talking about renewable energy, it's intermittent. And so the idea is the wind is always blowing somewhere. The problem is that's a multi-billion-dollar project to do that. So it is something that is being talked about at the national level. There was actually a conference last year in Iowa where that was introduced, and the National Renewable Energy Lab has kind of championed that project.
Thank you.
I think I sent out an article about that very point to the committee a while ago, to try to dig it out.
Thanks.
Yeah. So to kind of move from this, the point is right now, really our market is the West, and we compete with other people in the West. New Mexico and Montana are in kind of a unique situation where they can straddle the border, but they do compete directly with us in the Western power market, as well as having greater opportunity than we do for the Eastern power markets. All right, if we can go to the next slide, please. People have seen this before. All this is a map of where the best wind is, and this will be important as we talk about costs, because when the wind blows more, developing wind is cheaper. Really, all you need to take away from this is purple, which is the highest wind, basically occurs across 4 states. And so what you will find that we're talking about later on is, while we've often talked about Wyoming having the highest winds, generally our resource is pretty similar to the 4 eastern states in the Western grid. So that is Eastern Montana, Eastern Wyoming, Eastern Colorado, and Eastern New Mexico. All have very similar wind resources, and that will affect our modeling. If we can go to the next slide, please. Just to give you a sense of what's on tap potentially, this is the current amount of development in the Western grid with respect to wind energy, and you can see that California is about 3 times what Wyoming is, and Colorado is second in the grid. The numbers are a little hard to read, but what's important is the next slide, if we could move to that. And the next slide shows you orange is under construction, and gray is planned. So really, it's not so important what's on the ground as what might occur. So the takeaway from these past few slides is we compete against 4 states more than any other, and those 4 states have significant development either already occurring or planned. In Wyoming, it looks like we have a lot of development under construction, which we do, but that is one project which you're all familiar with, which is the Sierra Madre Chokecherry wind farm. You'll see that the other competitor states, New Mexico has a significant amount of construction and development underway. Montana doesn't look like it has nearly as much, but this is because of the transmission access issues. That's changing with closures like at Colstrip. And as you can see, Colorado has significant development, and they just recently turned blue from orange on a lot of projects. So they just came online. If we can move to the next slide, please. This is the set of projects that we track that are currently in progress in Wyoming. There are some that we don't know about. So the takeaway from the last 2 slides is that there's about 5,700 megawatts in the last slide of projects under construction, or what the American Wind Energy Association identifies as currently in advanced permitting or advanced planning. If we look at all of the projects, including ones that are recently announced and just beginning to start the permitting or planning phase, it's about 8,400 megawatts. We currently have about under 1,500 megawatts. So what we're looking at is about a 4 times increase. So we would be at about 5 times the wind that we have today were the projects online to actually occur. So there's significant development on the table. And of course, that question depends in part on tax policy. So this is just some background. And what we'll do now is just take you through a little bit of the benefits of a certain amount of tax or wind development, and what the tax revenues would be and what the economic activity would be. So if you can move to the next slide, please. So this is a paper that's been published in a peer-reviewed journal, so it's been looked at independently. What we looked at was about 6,100 megawatts of development. So we assume that most of the advanced planned and construction occurs, and some of the planned does. So we don't go as far as 8,400 megawatts. Next slide, please. That's just the background of what they were. If we were to look at the economic activity that those wind developments would create privately, it's about $7.1 billion, and about $3 billion would occur in the construction of the plants, with the remainder over a 20-year lifespan. The jobs that are potentially possible will not offset losses that we've seen in the coal sector, for example. But if all of those wind farms were constructed, that we assume you'd have about 3,300 construction jobs over a 5-year period, which would then go away. and they'd be replaced with about 1,400 permanent positions. Those are relatively large numbers, as you know, but they certainly don't replace, say, a significant number of coal mines. The number lost at Black Jewel was about 600 last week. We can go to the next slide, please. This is just a breakdown of if we were not to change tax policy, what our taxes would look like on these new facilities. And it turns out that would be about $1.9 billion over 20 years. We've not discounted this. And you can see the breakdown here. About a quarter of that goes to the production tax. The remainder goes, the dotted portion is the sales tax that we charge on wind, and the hatched portion is the property tax. So about 1.9 billion at current rates. If we go to the next slide, this is what increase to 5 megawatt or $5 per megawatt hour would do. We'd add another 1.9 billion, and it would be broken down this way, where about 1.5 billion would be the new facilities, and the remainder, just under 400 million, would be to existing facilities who now have higher taxes. We assume that in this case, we assume that an increase in the tax would not affect the decision to develop or existing decisions to operate. If we can go to the next slide, please. So this just gives you a sense of what the trade-off is. And I know this is a little bit busy, but there's basically some bookends to what we need to think about. If there were no tax increase and all of the development that we've talked about occurred, that's about a $9 billion gain to the state. 1.9 is in taxes. If we added $4 to the wind tax, to that 9 billion, you add the additional 1.9 billion from the new taxes. That's assuming that there was no effect on development for raising taxes. Now, if the opposite occurred, and this tax was so steep that it pushed everybody away, but we assume that the plants that are here still continue to operate, then that's an $8.7 billion loss to the state. What we would get are the proceeds of new taxes on existing plants, which is about $400 million, a little about 300 and some. But we would lose the economic development gains, and we'd lose $1.5 billion to new taxes. So the real question here is how sensitive development is to tax change. So if we can go to the next slide, actually you can skip this one to the next one. This is just kind of a trade-off matrix. Basically what this says, if we include private development, if 14% of planned development goes away, the losses would exceed the gains. In other words, those private benefits to the private economy from construction and operation, plus our tax revenues, would overwhelm the tax benefits of raising the tax. We can go to the next slide. Of course, because you're the revenue committee, you may not care as much about the private activity as just trying to make sure that the state has enough to operate. And so maybe taxes are what's most important, as opposed to private activity, which may occur elsewhere. If about half of that development were canceled, just on a tax basis, without including the private benefits in construction or operation, then the state would actually be worse off. So if we can go to the next slide. Basically, this is the question that predicated the study that we're going to talk about, which is how much of that development is likely to be affected by a change in taxes? And the answer is, and we'll be upfront with you, we don't know. There's no data to really look at how sensitive developments have been to changes in taxes, because there haven't been a lot of changes in wind taxes specifically in the country to look at. And secondly, if we did that, it would be a historical perspective, and the electricity industry is changing so quickly that that data may not be relevant. So what we did, we won't be able to estimate that tax sensitivity for you, but we can look at the cost and recognize that if costs change a lot, a company will probably choose to go elsewhere. And so that's what we've done, is we've done a comparative analysis across states of what tax policy does to the total cost of wind development to give you an idea of, what we might be looking at and where Wyoming fits in the larger landscape of how much it costs to develop wind in the West, because it is a competitive landscape. And so the question is, how competitive are we? We can go to the next slide, please. You want to take this over, Ben?
Sure. So this study that we kicked off with the cost modeling, my background is more on the oil and gas side than the electricity side, and we wanted to come at this from a financial modeling perspective of saying, if a developer was actually going to build one of these plants, how would they do the financial modeling from a cash flow perspective? There was a prior study called the E3 model, which I'm sure you've all heard about. We started there. And there were some differences in modeling choices that we felt like we could perhaps improve on, as well as update the data in terms of tax structure on the Western grid. So the idea is to compute what we call the levelized cost of electricity. I would just caution you that term gets used a lot in the literature. You'll see this levelized cost of electricity used to compare different sources of energy. But sometimes you have to really dig into how they calculated that to understand what number they're presenting. Because some papers discount to a constant rate, which is sort of like saying, if I set aside $20 today, I'll be able to buy a megawatt of that electricity in 20 years, if it earns the right rate of interest or whatever. And we decided that for the purposes of this paper, that was a little misleading. What we really wanted to do is figure out what the price of electricity would have to be to finance this project and get it done. What is the price? And we actually wanted to reflect the price. So we looked at different modeling frameworks. We looked at all the state tax policy, how different states tax wind, and how these projects are financed. One of the things that we looked at is, and I'm blowing way past these slides.
So can we move to the next slide, please?
Is when you look at how the projects are financed, one of the perspectives that comes up has to do with the subsidies or the production tax credits that come into play with wind. We know those production tax credits are about to expire, but our model sort of assumes that all these plants were under construction, or at least commenced construction, met the definition by 2018, so that they got a $19 per megawatt production tax credit as part of their financing. The way these plants are then financed by developers, they go get a group of people that actually have tax liability. Oftentimes the wind developer themselves will not have any tax liability from an income tax perspective or a federal income tax perspective because of the depreciation that's going into the plant. And so what they do is they go find people that do have tax liability. And this could be any corporation, it could be even private individuals if the conditions are met. And they pre-sell them the tax credits. It's sort of like saying, well, you have $10 of tax liability. I'll sell you a credit for that for $7. And so the person that buys that credit saves $3 on their taxes, and you get $7 to build your actual project. So even though the developer is looking at, say, like a $19 per megawatt hour production tax credit, they're not actually getting $19. What they're doing is getting $6 or $7 a megawatt hour upfront to actually help finance the construction of the project. Those tax credits are rarely monetized, meaning it's rarely sold for cash flow to pay for the operating cost of the plant. Just so you're aware, this is also the same exact debate that's happening on the carbon capture side. So as we hear more and more about carbon capture, the 45Q credits, the biggest thing going on right there is we haven't gotten guidance from the IRS yet to tell the financiers what the rules of the game are so that they can go try to find tax equity investors that are willing to put that capital up front to build those capture facilities. So it's the same kind of financing mechanism that's being looked at anytime you're talking about tax credits. We just sort of assumed that these would get that $19 per megawatt hour tax credit, finance it with tax equity. And you have to, when we talk to developers, the rate they said is, well, we'll take 8.5%. We want an 8.5% return on tax credits. And we assume direct equity, which bears a little bit more risk, was 10% return on equity. And the debt financing is about 6%. We can go to the next slide.
One other thing that we'll mention is the difference between this and the E3 model that was done a decade ago is the E3 model allowed you to input a price for wind. So you could make an assumption of what you thought wind would sell for. That's not really the way a competitive market works. A competitive market kind of works in the sense that you take the prices that people are willing to pay. And so what we looked at, instead of saying, this is the price that you will get for wind, what we said was we asked developers and we looked at the market and we said, what is the profit or the return to investment that is necessary before somebody will invest in a project? So what we do is we calculate what we call the levelized cost of energy, which is the break-even cost, what they need to earn on every megawatt hour sold on average from the beginning of the project to the end in order to meet all costs and ensure investors get the rate of return that they expect. And those rates of return are kept constant across all states. So so the differences between states in our model come down to three things: the tax policies within the state that affect the costs, the resource quality in the state that will affect how much production you can have, and the third thing are on-the-ground cost differences, for example, the cost of construction, which we'll talk about in a few minutes, or other costs that are different by state with respect to, say, construction and operation. Otherwise, everything is exactly the same. We assume that every project in every state is identical with respect to its size and with respect to the profits they earn and with respect to other assumptions that Ben will mention.
Yeah, so if we just assume a 300 megawatt wind farm gets built in each of these states, we wanted to calculate what is the cost of doing that. And so we just stuck with 300 megawatts in every state, sort of modeled it over 20 years, built in the tax credits that they would get from the federal level. We didn't put transmission costs in here. The reason is that those are idiosyncratic. There's a lot of site-specific issues that have to be, or questions to answer when it comes to transmission. Where you actually locate the plant is a difficult question to answer when you're looking at a bunch of states all at once. We just assume 50-50 debt equity financing, which is consistent with what we've heard from industry. If you go to the next slide, here's the list of assumptions that are basically constant across all of the scenarios. It's going to build $1,610 per megawatt to build this. So we go through this and say how much is subject to sales tax, how long is it going to operate, what is the construction time, and so forth. So all the assumptions there if you want to review them. Go to the next slide, please. Dr. Godby mentioned that there were some state-specific cost assumptions that we did allow to vary, and a big part of that was construction costs. We know it doesn't cost the same to build in every state, and there's labor issues and land issues and right-of-way issues that all have to be resolved. And so we looked at the Army Corps of Engineers cost index, their construction cost index, to basically figure out how to raise or lower that $1,610 per megawatt to account for those construction cost differences across states. Dr. Godby was telling me on the way over that there has been a little bit of change in these numbers since we did the study. It looks like California is coming down, and perhaps some other states are as well.
The main difference more recently, this was just released late last year, is that California has become a little bit cheaper. Wyoming and Colorado have risen by 1%. So effectively the relative cost differences are the same. The levels are slightly different. If you would prefer to have an update, we can actually show you what those numbers are. I've already run them through the model though, and they don't make any difference to the relative rankings of cost in the state, just the absolute numbers.
Go ahead and go to the next slide, please.
Okay, so the other thing that we need to take account of across the western states, if you compete against these other states, so effectively what states are doing are competing for valuable economic diversification. And it's the case that many of the western states have identified wind specifically as a source of economic development. So what this chart is, it's a little bit busy, but we actually evaluate the states based on their best wind sites. So we looked at what the capacity factor is. That is the percentage of a wind turbine's capacity that you could expect to get given that wind doesn't blow all the time. So if you have a 3 megawatt wind turbine, if the wind blew all the time, you would get 3 megawatts every hour. But on average, it blows sometimes at full capacity, and others it may be down to 0. So what is the percentage of that capacity could you get? And that's called the capacity factor. What we did was we used modeled results from a very large meteorological model that NREL puts out, estimating wind capacities by 2 kilometer square area across the West. And we took the wind capacities at the top 5% of locations within each state. In other words, the places where wind developers would probably most likely develop, where the wind is best. What you can see here is that the top 4 states are significantly higher than everybody else, and they're essentially equal. Those capacity factors are much larger than what wind capacity has been to date, but there are new technologies on the horizon that can capture that. Over time, they degrade. So what we do is we do 2 sets of analyses. We take one set of analysis where we actually allow each state to differ by its resource. And then to isolate the effect of taxes and costs, we do another analysis where we just force every state to have the same production capacity factor, which is that 35%. So you'll see when we show the results that there will be a high number and a low number. The low number will correspond to when you go to the best wind sites. The high number will correspond to the sites that have the lowest capacity factor that a developer would likely look at. The lower numbers next to each of the first, there's the far leftward column and then the second one. That's how the capacity factor changes over 20 years. So this model takes into account that facilities become less productive over time. And they depreciate approximately about 9% over a 20-year period in the high case, and a little less than that if you start at a lower baseline. If we can go to the next slide, please. So that's the set of capacity factors we used for the analysis to identify a best possible cost and a worst possible cost in each state. This is just telling you what the capacity factors are that have been realized in the Western states, looking at current data. And these are only wind farms that are serving the Western grid. So we excluded wind farms, for example, in Montana or New Mexico that actually serve the Eastern grid. And we already talked about that. What you'll see is, although Wyoming is often talked about as having the best wind resource in the country, at least in the continental US, from a productivity perspective, it has not usually achieved that. In fact, the highest capacity factors that we're seeing in the West are in New Mexico by a significant margin. In fact, their highest and most productive wind farm is a wind farm that was built in 2005. The equipment is actually considered outdated, and it's due for renewal very soon, but it's getting a 45% capacity factor, and they have several wind farms that have been able to achieve that. Colorado has been able to achieve regularly 40% capacity factors and above with older technology. The best wind farm that we've had in Wyoming was, by no surprise, our newest. And in 2017, it was only able to achieve a 38% capacity factor. So these are kind of the capacity factors that we see across the Western states. So while we start with a highest of around 50, which is what we were told new technology should be able to achieve, at least when it's new, probably closer to the midpoints of the ranges that we use, between 50 and say 41, is more likely for the 4 top Western states. So if we can go to the next slide, please.
So working with, and we had the opportunity to actually work with grad students on this, which is a nice touch. It's always fun to work with students as well. But we collected all the tax policies across all the states. Wyoming, of course, has a $1 megawatt wind tax. Most of the other states, you're looking at sales taxes or something like a gross receipts tax, which you might even compare to, it's kind of how we do severance tax in Wyoming for oil and gas. So we collected all those. The one state that had sort of two alternative scenarios was New Mexico, and it's because they have a provision in their code that allows for industrial revenue bonds. And those deals get negotiated more at the local level, on the county level. They can choose to offer an industrial revenue bond to incentivize economic development, which essentially gives some government backstopping on the debt side of the equation and can help lower the financing cost for the actual project. And so instead of, because it is a locally defined, locally negotiated issue, instead of just saying everybody in New Mexico does industrial revenue bonds, we sort of modeled it both ways to kind of constrain the range, saying at the high end, no industrial revenue bonds, and at the low end, they're going to use these industrial revenue bonds. If we were to raise Wyoming taxes from $1 a megawatt to $5 a megawatt, that's the other policy consideration. So you look at New Mexico, those two things, and then you look at Wyoming, status quo versus new policy, to kind of get the range of ideas that are going on.
Right. So what you'll see in the results, which we'll show you in a minute, are that Wyoming and New Mexico have two cost ranges. One where Wyoming uses current policy, one where, in a highest case that we know of, we raise the production tax to $5. New Mexico has two, one where they use industrial revenue bonding, and then the local counties negotiate taxes because the facility is effectively now a state entity. So it's not taxable, so they do a pilot or a payment in lieu of taxes with the developer, or they tax them using their tax codes and avoiding that. And we'll see that there are two ranges that are shown for that. One thing we did find out in our research, and E3 identified this as well, but couldn't say anything about it. When E3 did the study, they ignored industrial revenue bonding because they said they didn't know whether A, it was relevant, and B, how to model it effectively. What we've since found out is almost every project in New Mexico is using industrial revenue bonding. And so we did have to model it. And so the results primarily you should look at, when you look at the relative ranges, you should probably assume that New Mexico does use industrial revenue bonding as opposed to the case when they don't.
Next slide.
Question for this week?
Thank you, Mr. Chairman. Did you, in your research, discover a range of interest rate on the industrial revenue bonds?
We did. That's a great question. So we did find a range. What we did was we found that they were kind of converging to kind of a value that's expected. And so, and Ben could tell you a little bit more, we modeled the industrial revenue bonding on one of the most recent projects that was put together in New Mexico. I guess it was last year. Is that right? Yeah. So it's a very large project that's being put together. I think it was in Roosevelt County. And we used their industrial revenue bonding model as kind of for two reasons. One, because it seems that the other industrial revenue bonding deals that are being done are very similar to that. There's kind of a competition between counties, so they're kind of, there's a race to the lowest rate. And the other thing is that Roosevelt County and a couple of others are where the development is all happening anyway. And so that was the most relevant one. Does that answer your question?
What was the interest rate?
Trying to remember. Do you remember what the interest rate was?
4%, 2%, 5%?
I think part of the way it was handled was that if you get the industrial revenue bond, the portion of your project that's financed by the IRB is exempt from certain taxes. And so even if the finance rate itself, and I can't remember the exact number, were 6%, it would still actually reduce the cost of the plant because you're not, the state-owned portion of the plant is not subject to the taxes. So I can get back to you with that number, Mr. Chairman, Representative Sweeney.
Yeah, I think it's reported in the paper in a footnote, I believe. I can't remember what it is, or in a draft of it. But the bottom line is that the industrial revenue bond basically accesses you cost of financing that is closest to the lowest rate you can get, either a traditional debt or below it. So it was at 6% or below. I just can't remember what the number was that we used.
Thank you, Mr. Chairman.
Questions? Okay, Representative Collins.
Sure, I'm sorry, I don't know. Can we in Wyoming or any county use IRBs?
Dr. Godby.
Not that we know of. So bonding is a contentious issue. In New Mexico, they are allowed to use, and they've used this for not just wind farms, but many major manufacturing facilities use industrial revenue bonding, where effectively the county can bond the project, so it takes over a portion of ownership. That bonding then allows them access to lower cost credit than that a private company would get, because it's a county and it's backed by the state. Then, because it's a state entity that owns that portion of the project, they're tax exempt, so you have to go through a tax negotiation to say to the developer, how much will you pay us to cover the bond? So they're gonna definitely cover the bond, plus what are you going to pay us for taxes? And so what we did was we modeled this on the basis of what the most recent project that was found, that we could find, that used the bonding, what it did.
Thank you.
All right, keep going.
Okay, next slide. This just is a schematic that kind of shows how these different tax features or tax incentives are laid out across different states. You can see most states have no specific wind tax per se, but they might have other incentives. On the other hand, you do have something like a gross receipts tax in some places where they're actually taxing the revenue that's coming off of it. We just do it slightly different here in Wyoming with that tariff. I don't know if there's anything else.
So if you read this table, you should interpret the X as a benefit to the wind developer. So for example, Wyoming does not have a sales tax exemption, so it doesn't have an X. Many of the other states do, or they don't charge sales taxes. So that's considered a benefit. So the way to read this is just a comparative, and I know in the next portion of the meeting, you'll be talking about a document that tries to document some of the renewable taxes. We go much farther than that. We identify all the taxes that would be applicable to a developer, including any income taxes, gross receipts taxes, or regular property taxes that all industries would pay regardless of whether they're wind or not, unless they have an exemption. So the comparative thing to see here is that Wyoming's tax environment does not include as many benefits, for example, as say New Mexico's does, or Montana's, or Colorado's, which we'll come back to, because those will become the 4 states that are probably the most important as we consider where wind development might occur in the West.
Which better the case? They're not all equal, is what you're about to say, right?
Well, I certainly hear this argument, but just to add up X's and say that that's better than not having X's, because
This is just a summary table.
Yeah,
it's not meant to say any, it's just a comparative. What kind of exemptions are states giving?
Yeah, and just by way of example, if you don't have an income tax, then a state that has an income tax but gives an incentive on the income tax gets an X, and we don't get one. Well, we're the same thing.
We get an X if you don't have an income tax, which is what's up there. As we'll find out, and we'll talk about this in a few minutes, it turns out income taxes are really pretty insignificant to a wind developer.
Because they don't make any income.
Because they have high capital costs and a lot of debt. And so they get very large tax exemptions, which is the reason they sell their tax credits. They don't need them. And so they use them for financing. So it turns out that where in a lot of other industries, our lack of an income tax may be considered a benefit, in renewable energy or anything that's capital intensive, lack of an income tax is not nearly as big a deal, because typically when you're capital intensive and you have a lot of debt, you don't have a lot of tax liability. If we can go to the next slide, please.
So when we tried to lay out the modeling, the only thing this is a slide that's probably impossible to read on a screen like this. Basically, the way the model works is we calculate the system cost, we calculate the operating cost, and we cost how much the financing is, or we calculate how much the financing is. All of those things are taken into account, and we calculate the taxes for each state as we run this 300 megawatt development through each and every state and their tax policies.
So if we want to really just look at the model, while it's quite complicated to walk through the spreadsheet, and we have shared it with LSO, for example, basically there's 3 steps to calculating. First, you calculate how much the project will cost and what the sales tax are due on building it. Then you calculate the financing cost based on financing with traditional debt, money lent to you, with investor debt, and with tax credits. And then we calculate the operating costs. And the total cost of the development that you need to cover is the financing cost, which pays for building it, and the operating cost, which is what's incurred once you run the plant. And then on top of that, if we go to the next two slides, and we'll just briefly look at these, we then look at the types of taxes and how they add to those basic costs, and we just basically total them up. So there are two that are just added straightforwardly to the model. One is the property tax costs, which go on top of the operating and finance costs. The other is the wind tax cost in Wyoming. If we can go to the next slide. It's slightly more complicated with gross receipts tax and income taxes. We have to iterate in our estimation because an income tax depends on the the profit in each year. And so we have to calculate cash flows in each year, calculate the profits in each year, calculate the income taxes in that year, how they affect the profits, and then go back and do it again until you finally you iterate until you finally get the total cost of the tax. So we do that for both of these. But the takeaway out of the model is we calculate how much it costs to build, then how much we have to finance to build it, then how much it's going to cost to operate, and then how much the taxes go on top of that. And that is what our model comes up with. The number is the sum of those numbers. So if we can go to the next slide. So all of that is a preliminary to what the results are. So the presentation that we'll show you is basically a bar chart with a range of values. And we rank the states from highest to lowest. And when you look at the left side of the bar, that is when we're looking at the states, when we look at sites with their best wind sites. If you look at the right side of the bar, which will be the highest cost for a state, that is when we make all the states the same and we use a minimum number. So the lowest capacity number that might be developed in a state. Each of the bars include at both ends the differences in construction costs and the differences in taxes. So if we can go to the next slide, this is really the result of the study. And then we'll talk about some implications that may help you as you deliberate in thinking about how we might deal with this resource. If we look at the bars, New Mexico, when they use industrial revenue bonding, as they did in this most recent project, which is similar to others, the cost of development in the best places is about $32.18 for a 20-year project. As we go up the chart, then Montana comes in second at $34.43, Colorado at $34.72, and Wyoming at $35.44. There are two bars above that. One is New Mexico when they don't use industrial revenue bonding, and you can see why developers would prefer to use it. It is much cheaper. It comes in just behind Wyoming at $36, and then if Wyoming were to institute a $5 wind tax, it basically raises the cost by about $2.50. And that is due to a few different things. One is that production goes down over time as these things become less efficient. And it's also the case that the wind tax doesn't kick in right away. So it's not just a straight $1 ad, or sorry, $4 ad. It's about a $2.50 ad. So these are the results. And so what this suggests, what does this tell us? If we go to the next slide, well, if we can go back one slide, sorry. If we were to just say, so that the question we're trying to get at is how sensitive might wind development be to a tax change? So if you were to go with a $5 wind tax, you would raise Wyoming's cost by about $2.50. Wyoming is currently about 10% below what the lowest cost jurisdiction is to develop in, which is New Mexico. We're about 3% below. You could effectively think of Montana and Colorado as tied. We're about 3% behind them. So we're quite competitive at current tax rates with Colorado and New Mexico, or sorry, with Colorado and Montana. And reasonably competitive with New Mexico, although they have a distinct cost advantage due to their bonding process. And this is a reason that we surmise is behind why New Mexico has had a significant amount of development in the past 5 years. If you look at the Western grid, really the two states with the most wind development have been Colorado and New Mexico. If we go to the next slide, this is just a representation of the taxes that come per megawatt hour with each state. The blue bars are when you use the best wind resource. The orange bar is when everybody is at that low end of 35%. So it's more expensive because you have less megawatts produced to spread the cost over, which is why the cost gets higher. So what we do is we take all the taxes that are paid and we divide by the number of megawatt hours are produced, and that gets you the taxes paid per megawatt hour. So if you look at Wyoming in the center, for the sites that are most likely to get developed, assuming that capacity factor that technically is possible, we're told, it's about $3.05 when you're all in with all taxes under current tax rates. If we compare that to Colorado, it's $1.57. If we compare it to Montana, it's $1.82. And if you compare it to New Mexico, and the New Mexico in the center is with an industrial revenue bond, it's about $2.94. So right now, the tax take that New Mexico gets and Wyoming get are about the same. The difference in cost is due to the fact that they can lower the financing cost, which is the largest cost that a wind developer faces relative to the other states in the West. On the far end, you can see what would happen if Wyoming added a $5 wind tax. We would increase the tax per megawatt hour to $6.82 at the most favorable sites. So you can see, just comparatively speaking, the tax burden would move from the middle to being, when you use just states' best sites, the highest tax burden in the West. So again, the takeaway from this is what developers would be looking at. If we can go to the next slide, please. This is just a summary of what we've said. So if we can go to the next one. Basically, Wyoming currently is 10% more expensive than New Mexico and about 3% more expensive than Montana and Colorado. The other thing that comes out of the modeling when you look at the components of tax is that Wyoming's lack of an income tax really doesn't make a difference. It is relatively small in the total cost of wind development for any state, mainly because of the tax liabilities we talked about. There's just a little note here that said we do not discount flows of funds. So we count $1 million of sales taxes paid today the same as $1 million paid over 20 years. And you may argue, well, clearly I'd rather have $1 today than $1 20 years from now. That's true. The reason we didn't discount these is so that we could look very carefully at the cash flows. It is the case in talking to several states. We've also talked to people in Colorado about these results, and in New Mexico and in Montana, at least I have. They're also very interested in the results of the study. And the reason for that is because it seems that tax jurisdictions are much more interested in certain tax flows than they are in a single lump sum payment. And so for that reason, we also didn't discount the values. Not discounting is also consistent with, say, what industry studies do, like the Lazard study, which is a famous one for calculating levelized costs across technologies. If we can go to the next slide, please. Again, we've talked about this. If these are the effects of changing the wind tax from $1 to, say, $5, it basically increases the cost. It would basically make Wyoming about 23% more expensive, more than 20% more expensive than New Mexico, and about 10% more expensive than Montana and Colorado. So at those sorts of levels, we concluded that we should expect some effect on the decision to develop. If you raise taxes too much, it's exactly what we expect. We'll expect some developers to go to jurisdictions where they can effectively lower the cost. The problem is when you're trying to sell your wind across the West, the people buying the wind want the lowest price. And so if you develop in a lower price jurisdiction, you're more likely to be able to sell that power. If we can go to the next slide, please. To give you kind of an example of this, there's been an argument made that we just want to kind of put to rest here. There are some people that argue that because California has very high electricity costs, that if Wyoming's are lower, they will buy from Wyoming regardless, or they'll buy from any jurisdiction regardless because it's lower than theirs. But the way to kind of think about this is imagine you're a California tourist and you arrive at 3 gas stations, and the gas stations have the following prices. Now they're all much lower than what you would pay in California, which is like $4.25 a gallon. But because you're used to paying $4.25 a gallon, would you be indifferent to paying $3.03 a gallon versus $2.75? And the answer probably is likely no. And businesses are exactly the same as people buying gasoline. They want the lowest price. These numbers are arranged kind of in the order. The percentage differences between the prices. The $2.75 is what New Mexico would be like. The $2.93 is approximately, we took the midpoint between Colorado and Montana, and Wyoming is sitting there at $3.03. This is what current tax policy and other cost drivers make our relative prices look like. So we're relatively close. You might be indifferent to paying 10 cents more from one place or another. If we go to the next slide though, this is what happens if you add that $5 tax. And so if you were to just think of this in terms of a buyer, which would you prefer? At this point, you might have been okay with going, to $3.03 from $2.93, especially if those are the choices in a particular place. But if you increase the price to $3.33, chances are you would go somewhere else. Now, we don't know if developers are as sensitive as people buying gasoline, but we use this as an example to say, look, we should expect some sensitivity to this. If we can go to the next slide, please. So the result of this study is to say Wyoming is competitive at current rates, but we should be careful about what happens if we raise our taxes. But that is not to say we have found that we could actually tax smarter and actually increase our revenues, but avoid increasing the cost to the wind developers. And so if we're to look at what the drivers are of, and this is from talking to wind developers and also talking to other people who are involved in the industry, what is most important to you? And the first thing is the financing cost. Whatever financing cost is, that's the most important driver to a wind development. The production tax, it turns out, is a very significant driver. Do you want to explain to them why that is? The production tax and just the fixed cost?
Sure. So one of the things from a basic cash flow perspective is that a production tax, like a $1 a megawatt or whatever, actually introduces fixed costs into the revenue stream. And when you're trying to finance a project, the significance of that is that if the price that you're paying or the price you're getting for revenue varies, it actually increases the volatility of your cash flows to have a fixed cost in there. So if you're paying a 6%, say, severance tax, I'll go back to oil and gas, which is my reference point, a 6% severance tax, and the price of a barrel of oil goes down 20%, you're paying 6% of the 20% less, right? But that $1 fixed cost doesn't change. And so if the variable price of wind starts impacting whatever your power sale agreement is or power purchase agreement is, that $1 fixed cost actually increases the volatility of your revenue stream, and that becomes an added uncertainty on the financing side, which can increase your financing costs. So it's not really a question of should we or shouldn't we tax. In this specific example, it's that the way we tax can actually influence the way financiers look at the cash flows of the business, because one is more volatile than the other, and volatility means higher rates.
Yeah. So to kind of maybe put that in a little different perspective, we chose to do a production tax back when the cost of wind energy was somewhere between $70 and $80, and thinking back, Jeremy Case might remember better than me, it was much more expensive than it is now. And we decided to tax at $1 per megawatt hour. That price has not changed in a decade. while the cost of wind has dropped by about half. And so basically, the way we choose to tax has actually caused companies to feel like they have much more risk here, because every other tax, whether it were a sales tax or a royalty, for example, it would decline as the price fell. But what we've done is we've added a component to the taxes, which is fixed. And this just adds more risk to a company in a competitive environment. Because in Wyoming, you will always have to cover that tax, and it never declines if prices do. And in other states, we don't. So we're going to talk about that. And that's why it's the second most important driver. And we can't model that effect, but we know in talking to developers and just looking at cash flow, that the way we tax is actually deterring developers. It's not that they don't want to pay taxes, it's the risk that the way we tax is actually affecting their decision to develop here versus other places. If you were to look further down, sales taxes are the next most important thing, which is one of the reasons that so many states give it sales tax exemption. It's competition. And the problem with sales taxes to a wind developer is that you are charged for a good chunk of those sales taxes before you ever have any revenue. It occurs in the construction phase. And so you have to finance the sales taxes, which of course means that you're going to pay taxes plus interest. And so they don't like sales taxes. So the least important types of taxes are the ones that they seem to be able to deal best with, are property taxes or income taxes or something like a royalty. And the reason for that is, first of all, it kind of shares the risk between government and the company. If prices go down, government loses revenue, but the company loses revenue. So it shares risk. The second thing is, you don't have to finance those. You pay for those out of revenues of operation. So,
Representative Sweeney.
Thank you, Mr. Chairman. So when you say royalty, is that equal to gross receipts tax?
yeah, so in our paper, we called it a gross receipts tax because for wind, a royalty or gross receipts tax would be exactly the same. It's a payment based on your sale of the electricity. And the reason we use gross receipts tax, I know it's a little confusing in the paper, instead of calling it a royalty, maybe is because some states have a gross receipts tax on basically all transactions. And so we said, imagine that Wyoming used that. But when we use the term with respect to wind, if we use gross revenue, or if we were to say royalty, we're saying the same thing. It's a percentage of the sales revenue you make.
Mr. Chairman, follow-up.
Yep.
On that, in New Mexico in particular, because I really found that fascinating on how they're doing this. So is their gross receipts tax only on wind, or as you described, across the board?
It's across the board.
Okay.
Yeah, it has various exemptions based on whether you pay one type of tax or another. So without getting too deep into the specific tax policy of the state of New Mexico, and we had to go through this for all 11 states, and originally we looked at the entire country, which was just too much to deal with. Yes, the short answer is you would be, if you are not exempt from it from another action, then you would have to pay that as a percentage.
Another follow-up.
Yep, Representative Sweeney.
Do they have a corporate income tax in New Mexico?
I'm trying to remember, we have our chart here. I believe that they do, but I can't remember what the rate is. We have a chart in the paper that actually identifies what the business taxes are for each state. Just off the top of my head, I can't.
7.6%.
Yeah, that's the base rate, and then you can also get potential exemptions from that.
Yeah.
And that's where this pilot comes in that New Mexico does, the payments in lieu of taxes with the industrial revenue bonding, because now effectively the state owns a portion of the project and they're a tax exempt entity. And so they negotiate with the person who's going to cover the cost of the project, how much they will pay in addition to the financing costs that they're bearing with the bonds to cover a tax.
Good, Representative Conlon, Representative Blackburn.
Yeah, thank you, Mr. Chairman. Professors, I absolutely followed your argument regarding the kind of fixed dollar megawatt hour in relationship to fluctuations in prices and the percentage. But I'm curious about the relationship of a production tax, which doesn't come until a plant is online and actually selling. And your discussion about the most relevant factor for a company is financing, which happens all before a company comes online. And you didn't talk about that at all, because it would seem like a production tax would be of more interest to a company because they're actually getting revenue in at that point versus the decade that it takes to build a plant and the financing. So could you address that?
Dr. Cook?
Sure, there's a couple of things that come to mind. I think on the financing side, you start talking about the cost of that. I would go back a little bit to the uncertainty question. Yes, you know those are coming on, but the fact that if you're looking at developing in a state and you're trying to get financing and you can't model it, so you can't model the production tax because every year you don't know if the legislature is going to pass a new tax or not, that creates uncertainty for a finance developer. And so from my perspective, it's the uncertainty that's more important than whether it's a production tax or per megawatt or whatever. The fixed one is going to increase the volatility of the cash flows. The variable one, you just know what it's going to be. If you just say, it's like oil and gas. If you just say our severance rate is 6%, that's what it is. Then they can model it, then they have more certainty, then they can make more confident assumptions about what's going on. And so how they model these projects to get them financed, I think is where this question kind of comes into play. I don't know if I exactly answered.
I think I can answer it a little bit. So you're absolutely right. Financing is by far the most important. In our modeling, we assume that the financing situation is the same for each company. We didn't model an assumption about you're more likely to get financing in one state versus another or anything like that. So financing is by far the most important thing. That's why it's the first thing on this list and it moves in. Production taxes are a separate issue. So once you think about financing, then you go on to, well, what are the other costs that I'm going to incur now that I'm operating? Okay, and we talked about sale or while I'm still financing. So as Dr. Cook mentioned, if you have a production tax and there's uncertainty, then that becomes potentially a problem when you're financing because you don't know how profitable the company will be and therefore you're not certain what their creditworthiness is. Now, ignoring that for a while and just looking at the production tax on its own, once you've got the production, you've got your financing in place or you think you can get it anywhere, the thing is, what jurisdiction do you want to go to that makes it most likely that you will be most successful? And the jurisdictions that don't have a fixed component in their taxes will be more attractive than ones that do, because effectively what you have is a risk. And in a couple minutes, we'll talk about, so how can we avoid that by just taxing differently? So the conversation here is, could we tax differently and possibly avoid this trade-off between raising revenue and possibly losing development? And we think that you can do that. There's a limit, but we suggest that one possibility of raising additional revenue is to think about those alternatives. But the way it works is financing is the most important, what we've talked about. Then this fixed cost of production, which honestly developers hate for a variety of reasons. In our first report that was published, we actually did a survey of wind developers, and honestly, every single one of them, when it came to Wyoming, that came up. The sales tax is next, followed by those taxes that can be funded out of operations. So you're absolutely right. Production taxes can be funded out of operations, which is good. You don't have to finance it. But it's bad because unlike the other ones, it is one that they see as a potential point of risk because wind prices are only falling, and they're very worried about falling relative to other states. So you compete with other states who can now offer with new technologies a lower electricity price. They're also very worried about new technologies. I'd say wind developers' biggest worry these days is solar. And they're very concerned that they will be able to compete in the future against solar, which is potentially going to have lower costs than wind. And so if they can take any risk as prices fall, that tax chunk will stay the same. It won't fall with it the way a royalty would. And so they see that as a risk.
Representative Blackburn?
I'm good.
Okay.
If
Okay, go ahead.
if we go to the next slide, and I promise we're almost done. So there's a couple things that we take as lessons away that could be considered for the state. The first thing is the lesson from New Mexico. They have the lowest cost to develop, and yet they get tax revenues that are equivalent to what we get. And so how do they manage to do that trick? Well, the trick is that they look at effectively what their industrial revenue bond is allowing them to do is to attack what's most important to wind developers and help them with it, which is by helping them with their financing. And then they negotiate the taxes after that. And if you read the reports from different county commissioners, the county commissioners will say, we don't want to lose a penny in taxes. But the point is they can get that amount of money back because the wind developer is already facing a lower price to develop. And they still stay more competitive than we do. So one thing that we would suggest is looking at using this model, not just for wind, but for any kind of economic diversification in Wyoming. It was not really mentioned too much in the Endow report, but it is something that could really be, like New Mexico's used this to attract Google. They put a Google campus in Albuquerque using this bonding. It's something that may be considered. It is difficult, we know that. And the other thing is that it also moves the discussion of taxes to the counties. And we know that in Wyoming, basically we centrally collect and then distribute. But it's one possibility. If we can go to the next slide. The next slide is really just to say in Wyoming, we could potentially tax differently. So using what we learned from this, what we said was, why don't we avoid imposing that fixed cost, the production tax, and why don't we avoid imposing that upfront cost, the sales tax, and why don't we make that up by charging a royalty? And what we used was a royalty of 6%, which is exactly what oil and gas pay. So we said, let's just be consistent. So we'd eliminate the sales tax, and this is an example, it's not a proposed, but it's something to think about. And there are other various combinations you could do. We could lower or exempt, but what we're suggesting is just an example to show you what happens. We eliminated the production tax, we eliminated the sales tax, we replaced it with a 6% royalty, which is consistent on how we tax other sources of energy. And if you go to the next slide, that's just what this is saying. What we found out, buried in the results, probably should have put it in big red letters. What we would end up doing is lowering the price of development in Wyoming by 1.5%. So we would now be on par, or even potentially a little better, than New Mexico, than Colorado and Montana, depending on other conditions, specifically the resource in each individual place. But we would definitely become more cost competitive. We lower Wyoming's cost by 1.5% by avoiding that financing cost on sales taxes. The royalty also increases the average tax per megawatt hour from 305 to 331, which is not huge. I recognize that, but it is an 8% increase in our revenues over time from wind. So the bottom line is just by changing the composition of taxes, we could lower the cost and increase our total revenues, preserving revenue streams, which some people may prefer to a one lump sum hit of sales taxes and then nothing. Talking to the counties, they would love to see more sustainable. One thing about wind revenues on a sustainability basis is they are very unaffected by the economic cycle, and they are certainly unaffected by the energy cycle, right? They don't go up and down with oil and gas prices. So wind revenues as a stream are considered very secure and dependable. Now, there are other ways of doing this, but what we're saying is if you raise taxes, you might think about how they affect costs and think about the composition of taxes and how you change them. You can raise the taxes on wind, but if you specifically focus on the production tax, you may be doing more damage to yourself than if you look at changing how you tax. either replacing that or changing the other taxes involved. And that really, I think, is the takeaway from the study.
And Dr. Connolly?
Thank you, Mr. Chairman. Okay, your $3.31 per megawatt hour if we change our taxation. I want to go back to your gas tax, right? You had $2.75, $2.93. You made the argument that $3.33 if we raised to $5 would be too much, but now you're saying it would be $3.31. Now,
it would be no, it would actually be, we're not putting in the full $5 tax, we're just ignoring that. So the number would be 303 that you compare it to. So where we were at 293, 303, we would be down to about $3. Actually, sorry, it'd be 8% lower. It'd be about so I'm gonna have to do the math in my head now. So that was an example. So basically we're reducing the price of development by 1.5%, and you're raising your revenues by 8. So if you take that $3 example approximately, you take about 4.5 cents off in my little gasoline price. So now next to Colorado and Wyoming and Montana, we'd be about the same. So it'd be like 293, 293. So we would even our price. And we'd be closer to the lowest price, but we've increased our revenue total by over 8%.
Mr. Chairman, just a follow-up. So looking at those gas pumps is irrelevant.
No,
So
the idea.
Then, sorry, let me just finish. That the 331 that you said, that's not the same as the 333 if we had raised to 5, or the 303 if we kept it at 1.
I think we need to maybe put the pumps back there, but the idea was that was back when we're just referring to the $5 tax. The $5 tax basically really adds to our costs. And so moving from 303 to $3.30 whatever cents, that's the effect of increasing the wind tax by as much as what's been talked about sometimes. We're now talking about current tax rates, and instead of talking about that, what if we did something entirely different? And we're not arguing, we're just using this as the reason we chose this example is to show you that if you don't want to increase taxes too much, you can actually lower the costs and increase your revenue. So you can avoid any trade-off. Right? You make wind more attractive to developers and you increase your revenues. But you could also use the same thing we're arguing to say, well, maybe we do want to raise taxes a little bit. That's up to the state and of course you all. But if you do it differently, you may be able to reduce the impact on developers so that you reduce the negative impact that a tax increase has. And so our argument is really just look at how you tax as well as how much you tax.
Okay, any other questions before Senator Case gets going? Representative Roscoe.
Thank you, Mr. Godby. Is there any associated, if we the competitive in New Mexico, use the bonding, is there any associated risk with that the counties or the state would take on?
Certainly. We're bonding. And so any type of bonding, we're now the debtor. The creditor is now the market. And so certainly if there were any impact to those cash flows, then you would have a risk. So we're now flying in new territory, so it's off the cuff. Imagine, and we haven't talked about this at all, and certainly this is relevant to the conversation of wind development, environmental impacts. So imagine, say, a wind farm had a sudden loss of, say, eagles. This happens, they collide with the blades, they die. And they didn't have a permit for that. What if they were shut down for that reason? County's on the hook for the bond. The payer of the bond is not available. Now there are financial ways of avoiding that through, insurance on your debt. But the point I'm making is that it is not guaranteed that you will, anytime you take on debt, even if you're passing it through, if you have a creditor who's paying you, there's some risk that they won't pay you, which means that you could be on the hook to pay the market to ensure that you don't default on those. But that now we're getting into we did not evaluate the specifics of the risks. We're just suggesting that in this particular case, New Mexico is an example of a state that has used a unique method to both encourage development and lower the cost of that development. And so we identified it as one thing that the state of Wyoming might want to consider as we ask the question of how might we economically diversify the state.
Okay, one more follow-up, Representative Swinney.
Thank you, Mr. Chairman. So in regards to the industrial revenue bonds in New Mexico, do they require a match? Is it 100% financing tool? Because I believe we can do that in Wyoming because we have in the past with an industrial development revenue bonds and had a $600 million pool. But through the Permanent Mineral Trust Fund is where I think that financing option came from. But was there a match required to that? And then if you could also tell me how that royalty with their taxing methodology, you mentioned that they got basically a deduct because they financed.
Dr. Godby, if you know.
Pardon?
Yeah, go ahead.
Okay, so, and I'll let Dr. Cook chime in. So, quick answer to your question. We did assume a match in the sense that we did not bond 100% of the project with the industrial revenue bond.
No.
So the bonding, and I'd have to go back to the spreadsheet to find out what the percentage was that we used. I believe it was,
I think we just replaced the debt financing with the IRB.
which is 50%.
And
So
every deal will be different. Every deal will get negotiated at a local level, and depending on the circumstances of the company, who the developer is, and whatnot. I think we just assumed that the debt portion was replaced by the revenue bonds.
And the reason is just, if you were to see the spreadsheet, it's sometimes it's difficult to remember what all the inputs are. But to answer your question, in the model, we assumed that they did not 100% finance with the IRB. The second part of this comes to I think, when you're mentioning the royalty, for example. This would come out again in the negotiation of the payments in lieu of taxes. So, there isn't really a tax liability here on the private developer because the county owns a portion of the project. But the developer is being asked to pay monies instead of taxes to the developer on top of the cost of the bonding. And so that is negotiated. So the royalty part was when we modeled the royalty, just as an example, the financing occurs in a separate portion of the model, and we assume a certain amount of financing is being done at a certain rate, which determines the cost of financing. On top of the cost of financing and the cost of operation, we then add the taxes. So the taxes are separate, and they weren't affecting, in the way we modeled it, the cost that was being paid for the financing, except through the initial negotiation where we assumed that the company pays this much in addition to the financing. And we used, again, the model from the New Mexico development in 2018. We kind of use that as the template for the assumptions made of how much they're being taxed. So again, the idea is to use this as an example, something to think about. We are definitely not proposing on the basis of one run of a theoretic model what you should do, but what we are arguing is this is a place to start at. And we're saying you could think about these things. The industrial revenue bonding that's being used it's two parts to it. One is, while the state of Wyoming may have industrial revenue bonding available, it's really that part about the tax negotiation as well, to your point, that is really important and how that occurs. But there is the ability, if you lower the cost of financing, that you could actually keep your taxes the same or even raise them a little bit if you want to take some of that margin for yourself, because you're effectively lowering the cost by, say, $1. And then the negotiation is saying, so how will we share that cost saving? If you get 50 cents, you're still better off, and we get the extra 50 cents. That's good for us. And so those negotiations are important. And of course, in the state, counties don't have a lot of ability to negotiate those on a case-by-case basis. So, clearly there would have to be some potential changes, but it is something to think about.
Mr. Chairman.
Okay.
Thank you, Mr. Chairman. Dr. Godby and Cook, I really do appreciate your work, and I think it's really good stuff. We've talked about it a little bit before, and I definitely like the conclusions and the pieces and places we've gone. But I'd like to back up a little bit and maybe talk about you also looked at the patterns of benefits and costs of wind development and just the timing of it. And you made your presentation to the bar from Casper. I thought that was very significant. I was wondering if you could speak about that for just a second. Where you talked about the front end benefits versus.
Right. So I think what you're talking about is the streams of benefits versus the one-time payments. Is that what you were thinking of?
Well, you explained at Casper that the benefits are largely loaded up front. Or some of the benefits of the construction phase.
Right.
And who gets that and how that all works, and maybe discuss that a little bit.
Sure. So this goes back to the previous study to this one. So the benefits across a 20-year wind farm are, in total of operations, approximately the same as the construction phase. So effectively what that means is you get half of the benefits of a wind facility if you include the private benefits in the early phase of the project, even before it starts production, because you have so many people on site. The reason that wind is so cheap, one of the reasons in terms relative to other sources of generation, is because it uses so little resource once it's operating, right? It has no fuel, and it effectively employs many fewer people than, say, what a coal mine and an associated power plant would. And so the benefits accrue at the front end significantly, not primarily, but about half accrue in that construction phase, where you have kind of the very large project going into the ground. And then they accrue gradually over the next 20 years through the operations and the associated costs that would be potentially supplied to the community. In addition to that, there are benefits outside of the project itself. So this might have been also what you're referring to. So a good chunk of those economic development benefits are not due to the project specifically, but to the supply chain that is affecting the project and helping it, and also to the benefits of that new income that's introduced into the community. So you can have people in the supply chain benefiting from construction. And in our study, when we looked at 600 megawatts being built, a good share of the construction benefits are not due to the specific construction itself, but indirectly due to supplying it. And so the benefits are spread across the state.
Right, and so I guess another piece of this is a lot of those construction benefits actually accrue to people that aren't from Wyoming, and that's a piece of it, the secondary. And there's also this long-term impact that I think we have to kind of think about. You didn't model any environmental costs in your study, and you're not trying to do that. But if you accept that there's a loss to Wyoming of something that's going to be imposed on the landscape for a very long time, and yet you have a model that doesn't discount anything, and you don't consider those costs. So we sort of have this flash of all these benefits, but we don't really think about the costs. And I loved your idea of going to the royalties. I think that's really pretty cool. But when we look at oil and gas, there's actually, we call it royalties, but there's actually two pieces. We've got ad valorem, and then we've got severance. And the part of those two together are not 6%, they're closer to 12%. Right. And so that's more, and the reason we have the severance is because there's long-term diminution of our opportunities in to mine that in the future. We call it the severance of these opportunities. I would argue that there's a similar severance of opportunity that occurs with wind. Of course, wind is renewable, it's not equivalent to oil and gas, but yet the establishment of wind farms does sever vistas or changes the environment for a very, very long time. Maybe 100 years, maybe. So that part hasn't been built into this, and it's something to think about in terms of your royalty, that we might try to account for some of those costs in a royalty.
So,
Go ahead, Dr. Godby.
so framing your comments as a question, as how do we think about those things? We do not exclude the ad valorem or so income taxes due to, say, the federal government, which are part of the cost we model, the property taxes to the county, so the existing portion of, say, property tax would go to schools, for example. Those are all also included with the royalty. We're not replacing those. We only replace the sales tax and the production tax with the royalty. So the reason I bring that up is a quick clarification. We are including those, so in the same way that oil and gas has the 6% plus those other things, we do the same thing.
Right.
We just change the production tax and the sales tax to say, hey, here's a suggestion to just show you how this might work. It's not the only one, but it gets us into this whole idea. What if we change the mix of taxes in a way to work for the developers if we want that economic development and work for us so that we get revenues? With respect to your comment on vistas, the way we usually deal with what's called the externality of an economic activity, which you're well familiar with, is that we often tax. And so we are not arguing that taxes are not something that should occur to wind. We recognize we don't try to cost them out. That's actually a different study that's kind of ongoing now. We're trying to find out how people in Wyoming value wind resources and how much they're willing to give up in terms of vistas or potential access to public land. And so we're going out and trying to find out what the state's preferences are. That survey will occur in the fall. But we are arguing, so given that we expect there is some cost, we're not arguing that you shouldn't tax. So the basis for a tax, there are basically three reasons. One is clearly to raise public revenues, to provide public services. The second is sometimes you will use taxes to deter economic behaviors. Say, for example, smoking. If you can jack up taxes high enough, you might end something that, or reduce dramatically something you consider a social bad. The third reason is to internalize those external costs. So we're not arguing that there are no external costs, and we're not arguing that you shouldn't tax wind for that reason. What we are arguing is that as you consider the questions of taxing wind, we need to be cognizant of the fact that those decisions may also affect things that we are taking for granted, like the amount of wind that may be developed here. And so really what we're trying to figure out is how, without having any data to figure out how sensitive developers are, we're trying to figure out what components that are important to developers, how they change, for better or for worse, as we change the taxes. But I wouldn't argue in the slightest that, view sheds, environmental, and
That's fair enough.
Yeah.
I'm sensitive to time.
Sure.
We agree on this, Tobin. Could we get the slide back up that has the wind capacity factor?
Sure.
The wind map. Is that possible, Dean? It was way up early. And the reason I want to talk more about that, and we've had some kind of indirect conversations about it.
That's right. So stop, go back, go forward one.
It was actually,
Is it
I'm
this one or
actually
the
looking
next
for
one?
the map.
Oh, the map. You want to go all the way to the beginning. If you go all the way to the beginning,
Sorry.
so you're talking about the colored map?
The colored map.
Yeah, this one right here. Yeah.
So this is an astounding map, and you're right. We see this in many different places, but you sort of see a line of wind, and then you've got Wyoming where it's kind of sucked in, and that's actually the South Pass, the gap in the Rocky Mountains. It just sucks that funnel out. And so in your paper, you did a couple different ways of modeling it. One, you talked about taking the areas where you had the top 5% capacity factor,
Right.
and using that as a proxy for the whole state. That makes total sense. I understand why we do that. But another one was to take the 1%, I remember, and
35%.
well, that was your flat. That
Yeah.
was assumed was the same everywhere. But now, when you think about the way the grid lays over this,
Did you want to go to that now?
well, I don't know. I'd love to put them together. I have a map where it does it. But basically, a lot of the really good wind in Montana and New Mexico is actually in the other grid, but they are getting ways to access it. And you gave a memo about that, and I thought that was a really good memo. But this idea of proxying it with the top 5%, I kind of want to push back on that a little bit, because you're proxying up using 5% in each state, and maybe that's more equivalent than having this vastness of Wyoming with developable state areas that's very attractive. And then you look at other ratings of Wyoming, and we have the most areas of magnitude 6 and 7 or class 6 and 7 winds of anybody. So I'm just pushing back on the fact that proxying with the 5% across the states is necessarily good. I also think it's probably harder to take those areas which are located in the other grid and get them to the west, but you had a good answer to that. So really what it comes down to is New Mexico, a big player in the Northwest grid. And I know you know the company E3, you've mentioned them several times. E3 produced a study in January this year, they released it, and they talked about where they're going to get the renewable resources for Oregon and Washington. And in that, they basically take it out of Montana and Wyoming. Wyoming in spades, more than twice as much, or almost twice as much as Montana, and more than anywhere else in their area. And I guess the point I'm really trying to ask you about is if literally they're going to go to 100% reduction in greenhouse gases, and if you take the E3 modeling by 2050, they have nowhere else to go to get enough renewables. They, absent an incredible change in the grid or absent just astounding things, they have to come here. I mean, how do you get 33 gigawatts of wind out of Wyoming that's required for that, and 47 gigawatts from the Northwest and 18 from Montana? You just got to get it every place you can possibly get it, which tells me that if we really want to continue with these policies, which I think we do as a planet and as a people, and I think Washington and Oregon do, then New Mexico doesn't really play into that. And we have an astounding amount of wind no matter what the situation is, that we have to figure out how to handle. So the play is not like this year, although a lot of people think that what we do right now is very important. The play is like 10 years. Could you comment on that? And really that E3 study really struck me. We get buried.
So I think we'll both comment on it. So I know it's a little unfair to the rest of the committee that we're talking about a study that probably only the three of us have read maybe. So the first thing I'd say is that E3 study does project in their determination a lot of production in Wyoming and Montana for the Northwest. So the key to that study, it's kind of a crystal ball study. And the key to that study is their assumptions on transmission and their assumptions of what you could do if it was just possible to develop places given a certain set of limited assumptions. The way that the grid will probably develop, first of all, we won't be at 100% renewable for any time soon. And a whole bunch of things will happen along the way that will affect how we develop. And I often use the example of the movie Cars to kind of talk about this, right? So if you're familiar with the movie Cars, and if you've got kids or grandkids, you've probably seen it a million times because they watch it over and over again, right? It takes place in this little town called Radiator Springs, which to me always looks a little bit like Medicine Bow. The interstate, and that's in no way a slam to Medicine Bow, but the interstate bypassed the town. And the idea is that the town then end up drying up and it's a backwater. What will really determine the development of wind resources in the West is transmission development. And not only transmission development, but the order and use of transmission capacity that is associated with what we call generically thermal generating stations, fossil fuel powered ones. And what's really changing in the landscape, and we've talked about this, why did Wyoming have a huge wind boom that stopped in 2010 and then began very slowly again in 2016 with an ongoing project that requires transmission building its own as really the only other play. And now we're seeing a whole bunch of development. A big part of that is the opening of capacity and the development of new transmission lines that have been decades in the making.
I would.
Let
me add one thing, and the change in operation of the coal plant.
Exactly, and the change in operations of the coal plant, which is really what you're talking about is ramping, which is the first step to eventually shutting down. They've gone from running all the time to only running when they're needed. Unfortunately for us, the next phase is that they will shut down and they're not being replaced. So given that, as they ramp down, they open up more transmission capacity. And so to your point, and this kind of goes back to the last one, where the power can go from places like Wyoming or Montana is really very dependent on that very fast changing landscape of who's moving and who's not. So for example, in Montana, the early closure of Colstrip is now creating kind of a gold rush to get renewables in place around that transmission access. So I think this kind of relates to your last question. Absolutely, there is a significant amount of resource in Wyoming and Montana, also Colorado and New Mexico. The assumptions around Colorado and New Mexico really depend, well, Colorado uses a lot of its own power. New Mexico, they are building significant transmission, so there are other studies that I could show you where New Mexico becomes a huge player. And it really, the differences in the studies depend on how people assume the transmission grid will change. So without really predicting the future, and I'll let Ben speak, it really is that unknown, but it is also a really long-term play, and it'll also be affected by a lot of other technologies, for example, how we use storage and the different types of storage. And Ben, I know you wanted to say something.
Sure. So, Mr. Chairman, Senator Case, I absolutely agree with some of your caveats that there are some arguments to be made that we have an inelastic market, that wind developers are going to come here because we have a great resource that's available. I agree with that concept because I teach it to my MBA students every year, and we talk about inelastic markets and raising prices in inelastic markets because you can increase revenue. The other thing that affects elasticity, however, is substitution. And when it comes to wind power, there's alternatives, and those alternatives, especially and increasingly, are becoming solar power, which also has the opportunity and the advantage of having a peak of production because the wind happens, or the sun happens to shine about the same time that we use a lot of power. And so the production curve, the electricity generation curve for solar panels matches up with the grid a lot more easily than the intermittency of wind does. And so, yes, there are some things about Western versus Eastern grid that might increase the inelasticity or make it more likely that you would develop wind here. But if you have expanding infrastructure on the transmission side and you can develop solar resources that have less impact on the grid, that becomes a competition. And the developers that are in the business of renewable generation may be technology agnostic and may just choose instead to build renewable power in states where the sun is shining as opposed to where the wind is blowing.
And to kind of add to that, if we were a place where you're going to develop wind anyway and not other places, we're trying to struggle with this as we put it towards a journal, this report. How do you describe that? You may have just, one of the arguments to say that the wind market is more, quote, elastic or sensitive to cost changes than we might initially expect may be the fact that Wyoming didn't see a lot of development. Where is that transmission if we needed it? It seems like we took a long time to build some of it, but also people went elsewhere. And so that's a question that we're struggling with. We can't answer that sensitivity, and so we'll be straightforward with you on that. So all we're suggesting is, instead of worrying about that, why don't we just think about, we do need to consider it. We don't know what the answer is, and so we should proceed probably as very carefully and creatively to make sure that we can do this in the smartest way possible.
And I think you're exactly right, but it depends what you're trying to protect.
And
You know, you got.
clearly, not, I
Yeah,
did,
you
I
gotta agree on
apologize.
that. So-
Yeah.
But now there's just one more piece of this. So you talked about Powder River Basin coal and Montana's policies and Wyoming's policy. I'm arguing that we have the same situation here because Montana is, I think, for the Northwest, clearly they're in a very big driver in this, more so than I believe New Mexico ever could be for the Northwest. But that just means Montana legislators right now are struggling with this exact same issue. And what that really means is we should be working with our colleagues in Montana on working together, and whether it's an OPEC of wind or whatever, and I have already explored with their revenue committee chairman and some others, but there is ground, and there's definitely people there that have the same impacts as Wyoming. So can you speculate, what if Wyoming and Montana were to more unify their strategy and how that might play out with respect to these Northwest markets? And I'll leave it at that. You've really done a good job today.
I would argue that you're absolutely right. One avenue we could be exploring, OPEC might be a little dangerous.
Kind of a bad term.
Yeah, when cartels are kind of looked unkindly in the United States. But to your point, coordinating tax policy, right now, and the reality that we model is, if you want to call it this, in some sense a race to the bottom. Mm-hmm. The 4 cheapest wind resources have very different tax policies. And in fact, you can kind of bookend it with New Mexico and Wyoming having a pretty much more significant tax revenue drawn from wind. And former Chairman Madden used to talk about that wind actually kind of covers its costs when it enters the state because of the extra, what it pays. And then we could talk about environmental damage. Whereas then you have Montana and Colorado who basically, give away quite a bit of that tax revenue to attract it. I too have been approached by both states. This study has gotten their attention, and people in Colorado are looking at it to think about ways of maybe changing their tax policy. Montana passed 2 bills looking at overall state revenues, and you're well aware of this, and there's probably a really good opportunity right now. Utah has the same consideration, that as you get into the wider discussion of state revenues and possibly modeling the potential outcomes in the future, to think about what might be, that we think about how we might best think about. I won't say, it may be more difficult to actually have states match policies, but if we could coordinate policies, then not only would that help in terms of avoiding this competition, which really, if you're talking about tax revenues, we all lose, right? They play each, it's like having a kid with split parents, right? They go to one, they go to the other. Mm-hmm. So you could do it that way. The other reason to coordinate is so that you know that as you change your tax policies, you're already considering how the other state may be changing tax policies, and you're taking that into account so you don't unintentionally make things worse or sub-optimize your tax policy. So I would completely agree with you. If we could coordinate tax policies across state, or even talk about revenue changes as we think about modeling changes in the future, this could be really important. And with respect to wind, there potentially could be some real benefit to trying to find some unified policies that maybe all 4 governors could agree on, which could then lead to some legislative action.
Thank you.
Okay, any further questions? Dr. Cook or Dr. Godby, the committee, Representative Connolly.
Thank you. Professors, could you talk about the funding for this study?
Mm-hmm.
And is it public to all states, and this is a public document?
It is a public document. It is posted on the Center for Energy Economics and Public Policy website, and also the School for Energy Resources website. Initial funding the first study came from the Wyoming Business Council, and they were working with the Carbon County Economic Development. That was the question. When we take on funding for these, we're not acting as an advocate in any way. We explain to anybody who funds us that we are doing a research project, And if you would like a question explored, that the research project will provide the answers whichever way they go. It's you're funding research to answer a question. So that was the first study. This study, though, was in part funded by the Carbon County Economic Development Corporation. And the majority of the funding that came from the effort was the Department of Energy. I'm getting my grants mixed up. The Department of Energy, we have a grant at the university, publicly funded by the Department of Energy, looking at wind energy development. Just generally, it's a multidisciplinary fund, about $5 million of funding. A portion of that funding came to fund the study, not nearly $5 million, by the way. Most of that goes to the engineering portion of the study. So it was funded by the Department of Energy and some local funding. The results, but again, under the same basis. This is a research project. Results are disseminated as a research report, and it is treated in the university as a research grant, and therefore required to meet all the requirements regarding conflict of interest or anything like that, and also openness in the presentation of results. The results are developed not just for policy development in Wyoming, but they're also meant for a wider audience through academic publication.
Thank you.
Brooke, are you two sticking around through the lunch
I'm
hour?
afraid they are.
Okay. I'm just making sure if anybody had any questions, they can see the break for this week.
Mr. Chairman, thank you. In the modeling were power purchase agreements or PERPA in the mix at all in relevance to, development costs and taxation issues?
Yeah, so we didn't explicitly model PPAs. The functionality is actually in the model to do something like a PPA. But what we really wanted to know is what would be the price that the developer would be looking at when they went into a negotiation for a power purchase agreement, because that dictates how they're going to negotiate those terms. For instance, if you have to negotiate a power purchase agreement, your costs are, you need $30 in order to pay off all of your investors. Then that's gonna be kind of where you start with your power purchase agreement, and then you're gonna start negotiating various aspects of that agreement that might include something like accounting for uncertainty from policy impacts. There might be a clause in there that says we are going to either, you're gonna have to figure out how to negotiate policy uncertainty in a PPA or something like that. So we started from the perspective of just saying, what is the cost to get a sufficient return for the developer of the project? And that would become what would lead into a PPA. So we didn't model that explicitly.
So the short answer to your question is we didn't model specifically PPAs or conditions of purpose of the small 80 megawatt or smaller projects that basically utilities have to take their power. They certainly have some advantages in the sense that if somebody has to take your power and the price is known as the avoided cost, then the creditors face less risk in that situation. And so that might affect financing costs. On the other side, the avoided cost is often much lower than the developer wants to deal with. In Wyoming, it's been reasonably acceptable, but there have been long debates, for example, in Montana about whether the avoided cost is set too low for PERPA projects. So all of those things can come into effect and affect cost, but what we did was we just tried to figure out what is the base cost that a generic development would have to cover to ensure that its investors got what they expected was the minimum return. And we assume the market is competitive, so on the demand side, prices are basically driven down to the minimum acceptable cost that a developer can take and still make reasonable rates of return. And that was the way we dealt with it, as opposed to saying, imagine you got $50 per megawatt hour. And the reason we did that is that way we can, we're consistent with other studies, which also are modeled in that way. And the reason they do that is because now you're taking the assumption, as you compare across places or across technologies, you're ensuring that the investors all get the same return in different places. And that's really important because, in a competitive market, we assume that, returns get driven down to what's quote normal. If you just input an ad hoc price, we could do it, and as Ben said, we could just put a certain PPA across the markets. It would exactly reflect these cost differences, right? Because the difference in return at that point would exactly reflect the difference between price and cost. So if the price is going to be constant and it's the cost that varies, then we might as well just model the cost specifically. And that's why we did it that way.
Okay. Committee has any other questions for Dr. Cook or Dr. Godby? Check them at the break. With that, we'll take let's say a 10-minute break, which always is a 15-minute break, and come back at 10:45. Anybody see bike markers? Oh, really? Thanks, man, Sean. All right, committee coming back. We're going to continue our discussion on energy taxation. Moving on to adding some other energy sources into the mix. This is a revised memo from what you got last week from Dean. He just passed out. Are there copies of this in the back, Dean, or you'll put it?
I will.
Put it back there? Okay. I'm not sure exactly how it was revised, but I'm sure we'll find out here momentarily when Mr. Kemper gets back to the table. But as you remember, our last committee meeting, we had a bill, I don't know, 15 years ago to just have tax on electricity regardless of the source. I think Senator Mockler brought that. And so we, at our Lander meeting, said those type of issues we should be discussed and see where we are in relation to other states. And so also research and Mr. Tempe prepared a memo, which hopefully he'll walk us through here for a couple minutes when he's ready. Welcome, Mr. Tempe.
Thank you, Chairman Wanitzer. Thank you, Chairman Case. Thank you, members of the Revenue Committee. You did receive a memo that I prepared. It was, I believe it was dated June 28th. I received a phone call, a question about this that gave me the idea that perhaps the memo needed some revision to include some additional information. So that is the reason for the revision. I did not complete this revision until late on Friday. So I just brought copies of it rather than updating the Gov delivery. We will certainly do that today. Not wanting to read to the committee or anything, I assume that you read the previous version of the memo that I sent you. But I can talk to you, I will point out the specific items that I added in this revised version of the memo. One of the first things I added had to do with the state of Idaho. Idaho has a power generation tax of 0.5 mils per kilowatt hour. However, in looking at that particular tax closer, that particular tax is a tax by means of water power or by hydroelectric. I thought it was important to point that out. As pointed out, their taxes on wind and geothermal and solar. This additional tax, the 0.5 mils per kilowatt hour, was not on all power generation, but just on hydroelectric power. In terms of the production taxes in Iowa, right there is mentioned an electrical generation tax of 6 cents per kilowatt hour. There are several exceptions to that one, that kinds of power which are not subject to that tax. There are also a couple different taxes that are in place that are in lieu of this particular electrical generation tax. On, again, hydroelectric plants, the tax is a little bit different if the tax is on hydroelectric plants, and it's also a little bit different depending on if the particular company generating the power also has, depending on how many pole miles of transmission lines that they have to go along with that. Looking next on the state of Minnesota, I wanted to point these out, and most of the changes that I made had to do with what was discussed in Dr. Godby's and Dr. Cook's discussion, how, states may tax power generation, but what they do is they also allow for perhaps an exemption relating to the property taxes or to the sales taxes. and that is the case in Minnesota. First of all, there's an exemption to the wind generation tax in Minnesota. The tax does not apply to electricity produced by wind energy conversion systems located in job opportunity building zones. In Minnesota, all real or personal property of a wind energy conversion system is exempt from property tax, except that the land on which the property is located remains taxable. And also wind energy conversion systems that are used as an electric power source basically are exempt from sales tax in Minnesota as well. So as was discussed in the prior presentation, while Minnesota does have wind generation taxes, there are also certain exemptions for property tax and sales tax. Made an addition in regard to the solar energy generation in Minnesota as well. Personal property consisting of solar energy generating systems is exempt from property tax in Minnesota. And solar energy systems as defined in the state of Minnesota are exempt from sales tax. In regard to the the license tax in the state of Montana, new generating facilities with nameplate capacities of less than 1 megawatt and using alternative renewable energy source are exempt from property taxes for 5 years after the start of the operation. Generating plants producing 1 megawatt or more by alternative renewable energy source are eligible for property tax reduction on the local mill levy during the first 9 years of operation, subject to approval by the local government. Going on in regard to the information I added in regard to the state of North Dakota, the wind generation and grid connected taxes described for the state of North Dakota are imposed in lieu of all the real and personal property taxes, except for the property taxes on the land. Proceeding on to page 4. Also in the state of North Dakota, under the coal conversion facilities with electrical generation, electrical generating facilities are exempt from sales and use taxes. For wind facilities, the equipment must be purchased for wind facilities to qualify for that sales and use tax exemption. The equipment must be purchased between July 2011 and July 2017. For non-wind and non-coal facilities, the facilities must sell the electricity it produces or use it on site for a business-related activity. Going on page 4, in regard to the information added under the state of South Dakota, the tax is described above. The tax on electricity produced by wind farms and the tax on electricity produced by solar facilities are in lieu of all the taxes levied by the state, counties, municipalities, school districts, or other political subdivisions on the personal and real property of the company. However, these taxes are not in lieu of the retail sales and service taxes imposed. Proceeding on to the last page of the revised memo on page 5, for the state of Vermont, the solar plants subject to the uniform capacity tax are exempt from the statewide education property tax. And also in the state of Vermont, a municipality may also vote to exempt or stabilize a solar plant for municipal property tax purposes. Municipalities that impose a municipal property tax on solar plants are required to follow property valuation methodologies specified in Vermont law. And that concludes the additions from this memo from the one sent to you previously in your packet.
Mr. Chairman.
Representative Conley.
Thank you, Mr. Chairman. I have 2 quick questions. Dean, there's a clause that I don't understand that gets used, which is, and I'll just use Idaho as the example, where it says the wind energy tax and geothermal taxes in lieu of all other taxes on the property of the producer and shall reduce the property tax to be levied. And then the final clause is to the finance and annual budget. And I wasn't clear whose annual budget was being referred to. State, local, the company itself?
Representative Connolly, it is my assumption that that would be on a, since this is talking about it's in lieu of the taxes on the property. Typically, the properties end up being assessed and collected, at least collected at the local level. So it's my assumption that that happens to, in regard to local budgets, similarly to how values certified in the state of Wyoming to the counties. The counties use those valuations for the basis of their local budgets.
One more.
Yep.
Thank you, Mr. Chairman. And, I'm curious, if you did any calculations of the relationship of this chart to Professor Godby's and Cook's presentation on the levelized cost of energy. And that ultimately is it true that what they did is take the information that you have here and that they normalized it to come out with that comparison that we looked at?
Representative Connolly, Chairman Case, Chairman Wanitzer, Representative Connolly. The distinction between this particular memo and the work by Dr. Godby is that his was specific to wind, where this was more generally, what I remember the request being at the last meeting was the question on how other states tax power generation of regardless, and not just wind. So there's that distinction. I really did not try to compare this information to the information in Dr. Godby's presentation.
Representative Blackburn, thanks a lot.
Mr. Chairman. Dean, I was just wondering, since New Mexico and Colorado were left off of this list, why are we on this list since they're part of the top four?
Mr. Kempty.
Chairman Zwanitzer, Chairman Case, Representative Blackburn. The states selected here are the states that specifically have a tax on power generation. As it says in the beginning of the memo, states structure their taxes quite differently. Some of them tax based on consumption. Some of them tax based on power distribution. But those included here are those that specifically have a tax on power generation. And Colorado and New Mexico do not.
Just making sure I understand, let's say on Idaho, when it says 3% of gross wind or geothermal energy earnings, would that be comparable to the 6% royalty rate that was discussed earlier? I mean, that's the same type of concept of a royalty
Chairman Zwanitzer?
on gross energy earnings, yeah.
I think it's possible that is similar to the discussion of the royalty discussed in the previous presentation. My impression of these particular taxes is they were somewhat of a gross receipts tax, if you will, on wind or geothermal or solar energy in the state of Idaho.
Senator Case.
Thank you, Mr. Chairman. I think this is pretty cool analysis, and I'm glad that we actually did it. We found out there was lots more taxes on electricity than we thought. We found out that there's some megawatt hour based taxes that are, we were always told we were the only one. And then we also found out that sometimes some of the taxes are in lieu of other taxes. It would be interesting to see what that would be like. For example, if you took the Idaho tax of 3% of those earnings and you applied it in Wyoming, and then we netted out and made it in lieu of property tax, we'd be ahead or not. All of a sudden, and that gets at kind of what some of the things that Godby was talking about. So I think it'd be probably useful to take this and begin to go farther down that road. The other thing that I'm willing to bet is that of all the states that are listed here, if you were to actually look at the percentage of the tax that's paid by people within the state, the incidence of the tax, I would imagine that almost all these states probably consume more than Wyoming does. We only consume 15% of the power in the Rocky Mountain Power Territory. So that's a huge export of the tax. And we've looked at other taxes. We've looked at lodging tax. We talked about exporting 50%. We've looked at gas taxes, and we talked, there's some export component there. But there's a huge export component to an electricity tax. And the idea that, in other words, it's you allow credit for the other taxes paid somehow. For example, it might make it more palatable, and it might make it so that we're not picking wind over anything, but we just do it on the gross receipts, but we allow credit for all other taxes paid, just like we do with, in theory, with our Constitution and income tax. And that might be a very powerful way to impose a tax that is mostly exported, I mean significantly exported, and also would change over time as the technology mix changes and we have less production of energy that's tax intensive, and we move towards renewables that's less tax intensive, they'd have less deducts. So right now it's what, 10%, maybe a little over 10% is renewable right now. Well, in 15 years, I'm willing to bet that it's 80% is renewable. And we don't have a tax structure that moves with that. It's conceivable here. Could we do some more work on this, Dean? Excited? Say yes.
Mr. Chairman, Senator Case, we certainly can.
Do you have any idea, Dean, like the 3% gross tax in Idaho, but they don't have property taxes? What would happen if we applied the same rate in Wyoming? Would they be ahead or behind? Can we look at that?
Chairman Case, I'll be happy to try to dig into that question.
Is there more parameters you or the committee would like to explore?
Maybe some other people have ideas too, Mr. Chairman.
I think everyone else in the committee, I think the bill that I remember seeing, 20 years ago was really what Montana does in some, it's a license tax on all electricity generated, manufactured, or produced. And we looked at that, I think it was my first year, or maybe the year before my first year in the legislature, and it didn't go that far, but that concept apparently works in Montana, or is at least instituted there, and that's where I think the discussion started from. But I do believe, as we move to a different energy future, our taxation policies should keep up with that. So, but I would hope we do a little more specific of a mission for Mr. Tempe to go research then. So if there's some parameters we can set, Representative Sweeney?
Thank you, Mr. Chairman. I don't know if it's a parameter, but do we go as far as franchise fees? Digging down to that level, the city of Casper has a franchise fee with Rocky Mountain Power that is a sizable amount of money to the city, which is tacked on to individuals' bills. Should we dig that far?
And Dean, maybe some of my questions would be how recent some of these tax proposals are. I mean, some of them may have been in effect for 20 or 30 years. Some have may have been the last couple of years that states are trying to keep up with their changing energy environment. But any research on that, or perhaps what they sent, if they could, some more information on if it's a recent advent in their taxation, or it's kind of a holdover they can't get out of their statutes from long ago. Especially on some of the geothermals, I would think are newer, perhaps when the hydropowers have been around a long time. But, I mean, the committee, is that a place you want to go? I mean, we haven't talked much about taxation of solar. We had that discussion earlier on how that was more of an equity issue with renewables versus non-renewables, that this is one way to have that's an equalized, I'm not sure I want to call it more fair tax structure, but where we try to we don't try to pick winners and losers. But would that necessitate us taking off maybe the wind tax or a different type of structure? And I don't know how you feel about that, Senator Case. Comments?
Mr. Chairman, two things on Representative Sweeney's point about franchise fees. I think corporations is looking at franchise fees, and they are kind of another tax on electricity that's received at the local level. With respect to the solar issue, it didn't happen, it barely happened at this committee, I think, but at Corporations Committee in Casper and also at Minerals, they have been discussing the returns from solar. And I think maybe there's one of the lobbyists is here today, but or the lobbyists for the Trona industry. There's a brand new large solar installation in over in the Trona patch, and it's in your district, right? Both you guys. So what they found is that they can't mine the Trona underneath the solar installation, which is raising hackles about how much compensation we actually get for it. And we find out we actually don't get anything, but it precludes a lot of other use of any other resource there. And there's no industrial siting process to look at that. And it's maybe something that we want to take up. So it might be nice to have more generic taxation of these issues and less picking at technology. And so, yes, I think solar should be included.
Thank you, Mr. Chairman. And Senator Case, going to your question about other ideas for marching orders for Dean, I am interested in the question of that levelized cost of energy. I think that that's a relevant thing for us to address. And then along with that, economic diversification and incentivizing renewables in Wyoming as we kind of, and how do we start really thinking about that as well? And it seems to me, and this is just my 2 cents, that we certainly don't want lifetime exemptions. That concerns me when we have lifetime exemptions. But economic diversification to get companies here and to start with that development is relevant to me. So I'd be curious what other states are doing along those lines as well. What about those startup costs, for example?
Mr. Tempe?
And you have some.
Mr. Chairman, Representative Connolly, that does kind of remind me in regard to what I found out for the state of Montana in regard to their exemptions, but for a period of time. If it's 1 megawatt or less, then it's exempt from property tax for 5 years. If it's 1 megawatt or more, then the facility is taxed at 50% for the first 5 years, and then that 50% is ratcheted down, so it's paying the full amount by year 10. I think that's an example of what you were getting at with your question.
Any other questions or marching orders for Mr. Tempe at this time? Is that clear enough, Dean, on, I'm not sure we're asking for a bill draft yet, but perhaps that might be in order before the end of today, just as it had to be drafted and we don't have too many left. Senator Case, thoughts?
Mr. Chairman, before we say that's it for the marching orders, really let this percolate a little bit more. We've got more discussion around it today, and we can make kind of a bit of thinking.
And Chairman Case, Chairman Zwanitzer, Dan Noble of the Department of Revenue actually did provide an estimate, an updated estimate of the fiscal impact of perhaps the bill you were referring to that came up several years ago. So,
Mr. Noble here, somewhere in the back. I think you're being called up, Dan, but you made it till 11:17 this year. Welcome, Mr. Noble.
Chairman, It's a pleasure as always. No, it actually is. Thank you, Mr. Chairman, members of the committee. I'm Dan Noble, Director of the Department of Revenue. You should have a single-page document that is referred to as electric power generation in Wyoming. Back in 2009, I was asked initially by the governor's office, and then I believe we prepared a fiscal note on what a generation tax would look like in the state of Wyoming. And it had a couple parameters. One was that it would apply to all electricity generated in the state. And I think the rate was being bandied around quite a bit as to what it would actually, how much that tax would actually be. I updated the figures for how much power is generated from thermal activity, hydroelectric, and then other renewable sources for the 2017 EIA numbers. The crux of what was being attempted here was to allow for a deduction for, or a credit for severance taxes already paid related to thermal generation activity. And in order to come up with that, I looked to see where the majority of that power was being generated, and it's obviously from coal, and tried to figure out how much coal has to be burned in order to generate a megawatt hour of power. And unfortunately, there are numbers that are all across the board, and that does make some sense because the thermal content of the coal makes a big difference, as well as the efficiency of the power plant that's burning it too. So there's a number of factors that we'll never probably get right, but I picked the number in the middle, which was 800 pounds of coal to produce a megawatt hour of electricity at an average severance tax rate of 64.66 cents per ton. That generated a credit against the generation tax of $10,681,000. And at $1 per megawatt hour assessed against all Wyoming generation of electricity, the tax would generate roughly $36 million in tax. That would obviously be dependent on the severance tax credit and how close that is to being accurate. And that's, I think, somewhere where we can probably do some more work to find out what the average is for Powder River Basin coal. That obviously is different on the western side of the state where we have higher BTU coal, but also higher sulfur coal as well. So it will never be an exact number until we actually see the coal that gets burned. But it gives us a reasonable starting point for determining what the net amount of tax would be generated based on $1 per megawatt hour across the state. And I would stand for any questions. And there was a number of factors that make this obviously just a shot in the dark, if you will, as it relates to what activity, how much it would generate. And with the discussions that were held this morning associated with using a tax rate as a percentage or a royalty rate, you could certainly change this in a number of different ways and see how it worked. I would also volunteer to help Dean in looking at what the net effect of, and I think that's what you're really asking for, is after all of these payments in lieu of taxes are generated, what is the net effect of that tax on the state's bottom line? I think that's kind of where you're headed. I'll certainly volunteer to help in that.
Questions, Mr. Noble? Sir,
Mr. Chairman, this is very interesting. It's kind of a polar case because I think what it does say is we could lower our megawatt hour rate and collect the same amount of taxes in a different way. But in our Constitution, where we talk about an income tax, severance wouldn't be the only deductible tax. I mean, it depends how we structure it. It could be all other taxes. It could be severance, ad valorem, and sales tax, for example. So that would change this. And if we did it on the basis of a gross receipts, that would change everything in a big way as well. And maybe go down Dr. Godby's idea of making the tax less distorted. But, I mean, it's certainly worth looking at this stuff. When the bottom line of this is, there is no other tax that 85% would be paid by someone else. The ton-mile tax might have come close if it would have been constitutional. So that's pretty astounding. And then of the 15% that's left, that's paid for by Wyoming people, if you look at, Wyoming has the most lopsided electricity consumption in the country. And that most of the electricity usage in Wyoming is for industrial customers who are tied to certain places. They can't move. And so only about, let me try to remember my numbers, but about 70%, I believe, of all electricity is consumed by industrial customers, leaving, and this off the top of my head, and I'm sure I'll get corrected, leaving the rest to be only 30% collected by small residential and small commercial. And so it's really that 30% of the 15% that's left that actually hits the bottom line of citizens, which is kind of an astounding way to collect revenue. We need to look at this.
Further, Representative Smith?
Thank you, Mr. Chairman. So to the list, are we saying for Dean to also include a comparison on if you use the gross receipt tax? Are we?
Be hard to do. It'd be harder to administer.
Mr. Noble or Mr. Tempe, so something like a license tax that Montana uses, would that be the, listen to Senator Case's thoughts?
Mr. Chairman, Chairman Wanzer, I think a gross receipts tax can be extremely simple if you wish it to be. If you turn it into a quasi-income tax by allowing deductions for other taxes paid is when the complexity gets introduced into it. As it stands right now, if you were to convert this from $1 per megawatt hour to 5% or whatever, there really would be no change other than how the calculation is done. Okay? It's when you say it is done in lieu of property taxes, then you have to start looking at, okay, you just created an exemption for property tax on all that personal property for that particular producer. That has an impact on the state and quite substantially on local government in this state. So you've got to offset that and figure out what is the cost of that, and what is the net benefit to the state for this tax at that point. The same thing with sales taxes. Sales taxes have a state component and a local component, so there's going to be impacts there as well. And really, the net generation of this tax is what you're really looking for. What sort of revenue is created from the generation of this tax?
And Mr. Chairman,
Senator Case?
I think it'd be difficult to have it be an exemption of the other taxes. I think it'd be better to have the other taxes be paid and then have the taxpayer claim those against their gross receipt obligation. There is a complicating issue in that the taxpayer is the utility company, and some of the severance and the taxes paid on minerals, that could be a different company. So we'd have to craft this to allow those to flow through from one taxpayer to another taxpayer. But I think it would be appropriate. It's embedded in there. And the question is how easy is this to administer in the end? You're dealing with fairly large entities, which makes it easier to administer.
Mr. Chairman, that was one of the issues associated with this to begin with, is that you're saying that you're going to offer a credit for severance taxes paid. Well, it is the mineral producer that pays the severance taxes, and it is the utility that buys that fully taxed coal from the producer. So they would have no idea of knowing exactly how much tax the producer paid unless it was part of the arrangement between the two. And that would be problematic. But I'm not saying it can't be done, I'm just saying it would be a complicating factor for sure.
And can be researched, well, implemented is one thing, but research on how it would work and how our laws could be crafted, that's achievable at least, and then in practice.
Sure.
Okay.
Thank you, Mr. Chairman.
So there's at least a couple of sideboards on that issue, which I like. And then we'll get some public comment up here and maybe circle back and see what else we can do. Any other comments, Mr. Noble?
I have this time.
Okay. Any public comment on, welcome, sir. First one up. Welcome to the Revenue Committee. Revenue, New York.
Thank you, Mr. Chairman, members of the committee. My name is Joe Spearing. I'm with the Wyoming Contractors Association. We wanted to come up here and introduce a few of our members to talk to some of the other benefits that we see from wind energy. The construction side of things, some of those early benefits that were discussed earlier in the day has been a bright spot for a number of our members. Of course, we have Jeff McDonald with Oftedal Construction. We've got Josh Jameson with Granite Peak, and then we've got Rob Jonesma with McMurray Ready Mix.
We're sending some handouts around, but I'll go ahead and get started. So I'm with Oftedal Construction from Casper. In 2018, our peak employment was 163 people. I'm happy to tell the committee that in June of this year, we hit 230 people. And we work in Montana. Quite a bit's been said about Montana. Between you and me and the fence post, I don't think I would look to Montana for a lot of guidance on how to run Wyoming. That's just for me, and I work in Montana. In our Montana DOT job, 6 people. Our Montana, that's our home office where we started in the 1960s. We have 16 people. And we are working at Colstrip at the coal-fired power plant there. We have 27 people. We've worked at Colstrip, Montana for over 40 years. Every year we work for them. And we help build units 1 and 2, and we're going to help shut them down. And that's a real disappointment to us. We love coal, we love mining jobs, we love power plants, but that's the reality we're at after all those years working at Colstrip, is we're going to help shut them down. In Wyoming, we have 181 employees. Right now at the coal mines, 0. Coal-fired power plant, 0. Uranium, 0. Oil and gas, 11. YDOT, 12. We're doing a job for Fremont County out in the Gas Hills, 19 people. We're doing a job in Yellowstone Park for Fed Highways, 28 people. Our Casper office and shop has 31 people. When I started there in 1992, there were 4 of us. Wind farms, 36 people. New electric substations, 44 people. So our biggest headcount right now is working on the new electric substations for Pacific Corp, and we're very proud to work for them, and we're very proud of the investment that they're making in Wyoming. Just to hit a little bit on taxes, I know obviously this is revenue. Just on the 3 electrical substations in southern Wyoming, we're going to buy $6.4 million worth of gravel to help build those substations. That's just a tiny fraction of that investment. And we're buying from 2, Wyoming companies, McMurray Ready Mix from Casper. We're buying it from their Rollins Quarry in Carbon County. And Lewis & Lewis from Rock Springs is the other supplier that we're buying $6.4 million worth of gravel. This year, we're going to pay $320,000 in sales tax just on that one purchase alone. And again, that investment Pacific Corp is making is billions of dollars, and Wyoming's going to get a hell of a lot of money in sales tax from that. And that's a good thing. We deal with landowners. I think the wind farms are great. It's spreading wealth to rural areas that really need it. We worked at one of the, quote, smaller wind farms last year in Albany County. We paid the landowner over $80,000 in royalty gravel and $7,000 in water royalty money to help get started on that wind farm. And that's a good payday for a rancher. That is a good payday for a landowner. And if there's any questions, I'd be happy to take them.
Seeing none yet.
Okay, thank you.
Thank you. Mr. Chairman?
Thank you, Mr. Chairman. I'm here today representing the Granite Peak Group as its managing partner. The Granite Peak Group is a family of companies. We're headquartered in Wyoming. Our companies include several rail assets, construction company, land developments, properties, manufacturing, and logistics. And we serve many industries. Our companies employ over 300 people in the state of Wyoming. The companies and employees of the Granite Peak Group we benefit from current economic activity, and we rely on future development and growth in all industries to maintain and grow our presence and our jobs for our employees. My partners and I know that the wind industry, like all the industries that we market to, is a competitive business for development dollars and investment dollars, and that all factors are input into economic models. And so I'm just here to encourage the state to give long-term certainty, not to drill into the specifics, but I think certainty is the big issue for investment today and in the future. So I'm just here to as an industry and a group of companies that would love to and get a lot of growth out of growth in the wind industry, just to encourage long-term certainty for the industry. So happy to answer any questions.
Mr. Chairman.
Senator Ellis?
Mr. Chairman, just for the record, can you provide your name?
My name, Josh James.
Thank you.
Mr. McDonald?
All right. I'm actually Rob Youngsma. I'm the general manager. Oh, sorry, Mr. Chairman.
Yeah.
Rob Youngsma. I'm the general manager of McMurray Ready Mix. McMurray Ready Mix is a concrete and aggregate supplier, hauler around the state, does most of our work in Wyoming. Our work's varied from residential to industrial to heavy highway along the way, and the last few years it's really branched out into the wind energy industry. We're currently working on multiple projects in the state, including the Power Company of Wyoming's project, south of Rollins, and a couple of projects with Jeff McDonald, as he said, with Optidol, west of Medicine Bow. We employ 75 people, and we currently have over 30 of those working on those wind projects. Our industry has definitely changed quite a bit. There's a lot of opportunity out of there. With that, our employment has gone up from about 60 people 2 years ago to 75 now. So it's a substantial increase in the number of employees, and that's basically based on wind energy projects that are out there. We've paid a lot of increased, I shouldn't say increased, but additional sales tax, buying new equipment to do these projects, more crushers out there, more trucks, more trailers. Along with that, we have fuel taxes, more trucks out on the road, things like that. More employees out there, so those employees are out there spending more money in sales taxes, fuel taxes, such and so forth. So I would just like to say I hope Wyoming could find a way, other than a direct tax, to continue to support new business in Wyoming, as in turn it supports other businesses in Wyoming. And when I say that, I mean, I guess not a direct tax up front. I think there's ways to do this to continue to bring these businesses into Wyoming, and we can all benefit from it.
Questions for Mr. Young?
Second.
President Sweeney?
Thank you, Mr. Chairman. Does McMurray Ready-Mix, through the crushing operation and gravel operations, also supply suppliers such as mobile concrete?
Yes.
On these projects?
Yes.
Or does mobile concrete also have quarries and crush their own, or do they mostly buy in these cases for these two particular programs with Rocky Mountain Power and Power Company of Wyoming? Do they buy their aggregate from you?
Mr. Young? Yeah.
Chairman, Representative Sweeney. They are currently working out of one of their own quarries for part of the project and buying part of it from us. So it's probably 50-50 at this point, basically based on location as to what's relevant.
Mr.
Follow-up?
Chairman,
Yeah.
my point is that's another Wyoming company with great assets and also part of the mix of companies that we're seeing with wind. So, thank you.
Sir, Casey.
Yes, thank you. Can you, how about, this is fascinating to me. How much concrete goes into a foundation for a wind tower? One of the big ones.
Oh,
This would be very cool.
500 kilo.
Yeah, Mr. Chairman, I was at the first one they poured out at TV last week, and it was 350 cubic yards of foundation. Poured by mobile concrete.
How, Mr. Chairman, how big is that? Is that as big as this room?
Yeah, about.
You wouldn't know the carbon footprint of that concrete, would you?
No, I'm not, sir.
That's a lot.
Further questions? Representative Sweeney?
Just thank you, Mr. Chairman. In context, what's the average truckload with mobile's bigger trucks?
8 to 10 cubic yards.
So
That's a lot.
just so folks see those trucks going down the road.
35.
35.
Representative Connell?
Thank you, Mr. Chairman. And so, do any of you know that if a wind turbine is decommissioned, will you take up that concrete?
Nope.
If you would like anything to answer.
There are some other people in the audience that would do that, yes. Other contractors.
Further questions? Representative Roscoe, you look like you have one.
Just, thank you.
Your
Mr. Chairman.
comments? Sure.
Do you use fly ash in your concrete at all?
Yes,
That's a byproduct of coal.
correct.
And it reduces the carbon footprint. Less important.
Well, thank you all for being here, and my apologies, Mr. McDonald, Mr. Young, for switching you
That's
on.
okay.
Mr. Spearling introduced you right to left, and I thought he was doing left to right. So, seeing no further questions, thank you very much.
Thank you, Mr. Chairman.
It's an industry in Wyoming, hopefully. And Mr. McDonald, anytime, Alphenall wants to move their corporate headquarters to Wyoming, since we have 3.5 times more employees, we'd always encourage you to. Just
I'll
letting.
pass it on to the board of directors.
Thank you.
It would make me happy.
Other public comment on electricity. Welcome, sir.
Thank you, Mr. Chairman. My name is Billy Bratton. I'm from Casper, Wyoming. I'm one of the owners, me and Jim Moore, of TP&L and GSS. They're both Wyoming companies. We're in the logistics part of it. You guys haven't heard much about the logistics part of it. There was a bill 120, that would have helped some of the logistics complications of the taxes for our state that was passed by several of you, and I thank you for your votes. And then went on to the governor, which was vetoed on the last day, unfortunately. The bill was introduced to help with logistics. We have rail yards in 8, counting New Mexico as of last week, 8 states. And the infrastructure for the rail systems is you build the rail systems to move the product. It's big product, it's heavy product, it takes up space. With the PTC tax credits, it requires storage up to 4 years. So a lot of our yards have products sitting on them for 4 years. A lot of developers are buying product for 2023, 2024 currently, and they're moving them as we speak, putting them in forward storage, even with the PTC tax eliminated. So what the problem with Wyoming is we have a tax that charges for storage. It's our property tax. So we can't bring product into Wyoming. And this bill was to exempt that tax. Unfortunately, it was vetoed, so most of the product we're sending into Kansas right now, and Oklahoma and Nebraska, and we'll truck it over in a couple of years for the bigger projects. So that some of these projects were on the board, some weren't on the board. Fortunately, we get to sit into a lot of meetings with developers and where they're planning before their public knowledge. And the tax in Wyoming is scary, especially since the governor put a big veto on something that would have said, we're open for business, no, we're closed for business. So you guys have a real big challenge to recruit more development in our state. And you guys have my sympathy, trust me. A couple things about the taxes in Wyoming, and I think I heard it right, 800 pounds of coal makes 1 megawatt. Well, if you do the calculation, that's 26 cents per megawatt. wind pays $1. That's a pretty big difference there. Another factor, for instance, the Cedar Ridge project, the Industrial Siting Committee gives $10 million for impact. That's for the roads. They're going to be on the roads with this big product coming out of Casper, wherever they decide to bring the product, Cheyenne, Douglas. There's several locations they're looking to land the product. So Natrona County gets $3.2 million of that. The rest goes into Converse County. And that's to pay for roads. It helps with fire. It helps with the hospitals. Out of that money, that all comes from the wind forward tax. If you drive up 59, it's a pretty busy road right now with all the drilling going on and all the pumping units. So, of course, oil and gas are exempt. They don't have to pay any of that. Or there's no impact. They can go do what they want. The turning lanes that have to be put in, that all has to be paid by the wind industry. So there's a lot of other factors that, we haven't discussed here, but the wind goes ahead and pays in advance to improve our infrastructure. That isn't, if we're going to have an equal across the board, we need to really look at all the equals across the board. And I realize there is some impacts with the wind, but when we deliver the product, that's a 13-week window we deliver the product. After that, we're not on the roads. So it's not a long-term deal, it's a short-term deal. It's an awful lot of money that we're giving to the counties for impact. The other thing I want to talk about is New Mexico, because we just locked up a deal in New Mexico, and that is the next boom. That governor's standing on her front porch screaming, I want wind and I want solar. I met with both our governor and her in Vail, Colorado, and she is pro-wind. She sat down with every single legislature one-on-one and said, do we have a problem with this? And she went down individually with each one and worked everything out so they could bring wind into their state. And that is, they also have a $3 million grant for any infrastructure, whether it's roads you're going to improve for wind or any improvements for rail facilities, which that's what we're looking at. Currently, we have 350 employees. Unfortunately, we only have about 12 in Wyoming. We would like to bring more people back to Wyoming. By doing this, if we can get 120 reestablished, we have the opportunity for that. But if we continue to push more for taxes, you're going to see development fall off dramatically in 2020.
Mr. Chairman.
Questions, Mr. Bradley? Representative Sweeney?
Thank you, Mr. Chairman. Thank you, Billy, for being here today. On House Bill 120, which the House and Senate put through, when you explain the exemption on property tax, does that, in your mind, go away forever? Or once they get tipped up in the destination, which might be not in Wyoming if they were shipped to, say, Casper to a hub, is that forever, or how in your mind was that supposed to work?
Brad?
Sure. Well, the bills wrote that you had to pay your sales tax the day it landed, you took possession, and then you were exempt until it was in production or 2 years. So it had to be producing electricity or up in the air, or if it sat longer than 2 years, you started paying your sales tax on it. And it was an incentive to, and it's not just for wind, it's for all energy. We have quite a good product for Chesapeake and several oil companies sitting in our yard that they'll have to pay taxes December 31st. It's been built ahead of schedule. There's a couple companies down in Colorado, and there's a couple manufacturers here just testified we have some of their products. They've already sold it, but it sits in our yards until it has to go to the field. Well, if it doesn't leave our yard on December 31st, they have to pay a property tax on it. So it would have helped all of the energy sectors. Majority of it would have been wind, not hiding the fact that it would have been wind. But that did impact from them bringing it to our state directly. And so it was only exempt for 2 years.
Mr. Chairman,
Yep.
So to be clear, property tax, once it goes into production, then the property tax after 2 years or 3 years comes online. It just doesn't disappear magically.
Mr. Chair, is that correct?
You have that correct. I know that when I met with the governor last week, he said that the bill's been worked out. He likes the new look of it. He wouldn't share with me what that look is. So I don't know if it's been changed, but at the current time that it was voted on, it was a 2-year exemption. From that, you start paying your property tax. The offset of that was you got your sales tax up front. So you got your sales tax 2 years before the product was bought, because traditionally, they would buy it when it lands on the pad. So this was a system that would have got more revenue for the state up front, and you'd have waited 2 years, and then you wouldn't have that sales tax, but then the property tax kicks in. So it benefited the state 2 years ahead of everything.
Mr. Chairman.
Another follow-up, Representative Swing.
Thank you, Mr. Chairman. At the appropriate time, I would like to urge the committee at looking at bringing back House Bill 120. I don't know if another committee is currently looking at it. I have brought copies of the last bill that the House, and again, the House and Senate passed. If we, at the appropriate time, I would like to address that with the committee.
And then committee, this bill actually 120 went through the Minerals Committee in both the House and the Senate. I don't know how it was in the Senate, but it was a fascinating discussion on the floor of the House, and actually me and the Vice Chair both voted no, only because of some of the exact issues the governor raised in his veto letter. That the idea is, and if you look at the vote, it was in the House, it was amazing. It was the Democrats and the Majority Leader and I and Chairman of Labor Health. There's, I think, too many unanswered questions. But as I was reading the governor's veto letter provided by the good co-chair, he even encouraged us to review the bill. But I have no idea if Minerals is looking at anybody else. So, if Minerals Committee is on their interim topic or anything. So maybe the appropriate time, we'll entertain that motion and have that discussion after we go to public comment. That's okay. Further questions, Mr. Breton?
Mr. Breton?
Yeah, Representative Connolly.
Thank you, Mr. Chair. Mr. Breton, I am curious about the meeting that you had, I think you said in Vail, with the governors of New Mexico and Wyoming. And I'm curious about the content of that meeting, if you can share it, regarding the incentives from one state versus another. See, I mean, it was a joke, but the notion of the wind OPEC, I think
Was
is.
it really a joke?
I know.
It's a bad name.
It was a bad name. Actually, a very curious concept, and the discussion was about Montana, but thinking about including New Mexico in there. So I'm just curious about that content of that meeting that you had, if you could share it with us.
Mr. Breton, if it wasn't private,
Mr. Chairman,
please do.
thank you for the question, because it was my first time I've been to the Western Conference of the governors. So it's a coalition of roughly 9 governors, and you get 30 minutes of time with them. And so I went in there with some developers, some that are developing Wyoming, some that aren't developing Wyoming, that are looking to come to Wyoming, and the other states that we went to. When we talked to Governor Gordon, it was regarding Bill 120 that I brought up. Wanted to talk to him if he understood the bill correctly, and he said he's working on it. And that's really the only time I had. But the one thing he kept bringing up to the developers is he having a hard time with wind, because he just, the problem he had with wind is if you develop a wind farm, you can't mine Trona. You can't get the Trona, which is interesting that he said that. And so that was his whole holdup for wind. And when we went into the governor of New Mexico, it was a laugh, joke. It was a whole different attitude. She was welcoming us. She was, what can I do for you? Tell me what you need. I want wind. I need more people moving to our state. We're a senior citizen state. What can I do to help you? And we told her what we needed, and she says, I'll get right on it. They've contacted us every single week with development. So it was night and day. It was totally 2 different meetings that we had. Same people in the meeting room, but 2 different governors. One other add I would like to add, and Senator Case keeps mentioning this is a pass-on tax. I'm a customer of Rocky Mountain Power, so it's passed on to me. I will get this tax. I'll pay it personally, and my companies will pay it, and all my employees will pay it. And the other thing is, when you sign a PPA, and you might understand this, if you sign a PPA for $20 a megawatt and you're paying $1, you can't pass that on. It's already sold. It's already locked in. You don't get to pass that tax on. You've got to eat that tax if it changes. You can't go to the PPA that you sold and say, oh, and by the way, I'm going to charge you guys X more. It doesn't work that way. It is a locked-in commodity. It doesn't fluctuate. It's a locked-in price. That's why a lot of the power companies like these, because if coal and gas fluctuate, this is a locked-in price.
One more, Representative Sweeney.
Thank you, Mr. Chairman. Bringing that up, do you think, I don't know if you were here for this morning's information. Do you think a gross receipts tax would be a fair way to look at that consistently? I mean, there'd be a lot to work out logistically. And then also, what do we do with, sorry to name names, but Power Company of Wyoming may have to opt in, opt out. We may have to do something different because of the size, scope of that. Do you have any thoughts on that?
Mr. Brendan, you do?
Yes, Chairman. Yeah, I do. I agree with Senator Case. There might be a percentage you put. It makes more sense. If you produce more electricity, we make, more money. If it goes down, their costs go down. It would be in line with coal and oil. I can't imagine if we said, oh, we're gonna charge $10 a barrel to the oil guys, flat $10. And oil drops to $20, what would they do? Everybody'd be out of business. So you kind of got to look at that model a little bit, and that's been successful in the state. And same with coal has been successful. So I think that needs to be looked at pretty hard in Wyoming. I believe in the percentage would make more sense than a flat amount because the costs are going to continue to come down with technology.
Thank you. Thank you very much.
Thank you.
Others? Come on down, ma'am. That guy's name on person, do the messages.
Hi, I've addressed you all before. I'm Cindy Wallace, Executive Director of Carbon County Economic Development Corporation. And I represent the county where most of all the wind development is happening. There's 6 counties right now in the state that has wind development. There could be a few more, but we have the most. We could have up to 8,136 some odd megawatt development, which would make us the wind capital of Wyoming and actually the wind capital of the whole country. Sweetwater, Texas claims that right now, and we will surpass that. And they even have it on their billboard coming into their town and their sign with wind turbines claiming that they are the wind capital of the country. We're going to bypass that. I've been in economic development for close to 26, 27 years. I've been in Wyoming now for 10 years. So I dealt with, in my economic development job in Kansas, that's where I'm from, we have a lot of wind industry there, as well as manufacturing plants, lay-down yards, nacelle companies, all of that, and the whole industry around it. So this isn't new to me. I worked with a lot of farmers and developers also that came in. In fact, I have some land in Kansas. I would love to have a developer come and it would help out my income on what little I get off the farm income. But anyway, I'm representing also, and I'll get to that in a minute, I'm also the vice chair of our Carbon County Visitor Council Board of Directors. So I'm going to address what they had. I just came back from visiting family in Kansas, so I don't have the letter from them, but she sent it to me via email. So I'll pass that on. But the wind power industry, it brings us new revenue, new jobs, and it just trying to come up with different industries trying to come into your area and your community. We have a chance for close to $12 billion in capital investment alone in our county. And we're not having to pay them any incentives. They're not asking for anything. They're not asking for grants through the Business Council or incentives or say, take away property taxes. Compare that to when Amazon was looking for their headquarters all over the country. They were a $5 billion capital investment. We've got close to $12 billion. Right now, between Rocky Mountain Power and their projects and the power company in Wyoming, with their transmission lines as well, that's $9 billion capital investment. Now, when you all want that to come to your state or your county, and each county has the right to say if they want wind development in their county or not. That's why there's all these regulations out there that they have to go through. They have to meet all the permitting criteria, and there's federal, state, and county permit regulations that exist. If your county doesn't want it, that's fine. You have the permitting and the regulations to say yes or no to it. So if you think the whole state would get the wind projects, it's not going to happen. There's parts of the state where the wind projects won't actually work very well. They just don't have the wind resource there. But in Carbon County, we have probably some of the best wind resources, and this is one of the best economic opportunities that we have. We've got small rural communities right now that are suffering, and right now, this is a bright spot on the horizon for a lot of our towns. Medicine Bow and Hanna especially is going to benefit, but it's going to benefit not only our county, but the surrounding counties around us. When Hanna lost their coal mines in the early 2000s, they've lost over half their population now. It was major. Nobody came in to help Hanna. Nobody from federal, state, or local, they didn't come in and say, we'll help you, let's do this, we want to keep your coal mines there. Nobody helped them. This is a bright, bright spot, especially for our little rural communities. They've already got some businesses that are looking at opportunities to open up. We've got a restaurant that closed down, they're reopening. With all the construction people coming in, it's a great opportunity. There are campgrounds, they're reopening campgrounds, developing things. The hotels are full. We've got a tire shop that wants to come in out there. There's other companies that are looking to come out. I went to the Wind Power Show last year in Chicago and in Houston this year, and I brought with me maps of all of our wind projects that are coming in. And there's companies out there these are the ancillary companies that would come, because there's people that's got to do all the repair work. So repair work and servicing, and there's other opportunities, setting up offices. So it brings other jobs. We're wanting to diversify our economy. INDOW shows, diversify our economy. Well, you've got it right here with our wind energy business. And us in Carbon County, this is an opportunity that we can't afford to pass up. I've gone out and tried to recruit data centers. We had a visit, but we're not large enough. Look at opportunities that this brings to some of our counties, not only to our counties, but to the whole state. The money that it's going to bring in is going to benefit, and that's where you get your economic diversity. I think I've also talked, let me see, I sent you a letter about this. If all our wind energy projects happen, we'll have 318 new jobs. 318 in a county of less than 16,000 people. It's going to benefit and bring in more people. Right now, kids are leaving there's opportunities, when they get out of high school or college, there's opportunities to keep our kids here at home through the wind technician training program and the various jobs that these companies will bring in. In fact, Laramie County Community College has their wind technician training program. And our Carbon County Higher Ed would like to possibly bring in some more training programs for this. This could keep some of our younger people at home and bring them in. And I think you're all wanting to hopefully make sure they come in. So we are against any increase of any of the wind production tax. Leave it alone, leave it where it is. Let everything happen. It's going to end up being better for the state and for the county. It will bring in more funding and more money, because right now, if taxes keep going up, there could be a few developers that will not even consider coming in now. And I'm going to address the visual impacts that you keep bringing up. First of all, from our Carbon County Visitor Council, our wind, I'm going to pass these around. If you look, one of our tourism stickers, you look up on there, you're going to see we have wind towers. We consider this part of our landscape, part of our what we represent. And we see it as a tourist opportunity. The visual impacts, we've brought in travel writers, TV stations, people from other countries, environmental people working on stuff. There's been all kinds of visitors to our county that's come in, and they stay in our motel rooms and spend money. And we'll be getting more. We see this as a tourist opportunity for our county as well. I understand our company in Wyoming may put some interpretation signage out and talk about theirs. Theirs is going to be the largest wind farm in the country, could be the world, but that is a tourist attraction, and we can make it that way. And Carbon County Visitor Council, like I said, those are their stickers they developed. But they don't see that our tourism has been even negatively impacted by anything, the installed wind energy that's already there. And they recognize that wind turbines are part of our local landscape, and they've identified them in our Carbon County sticker. And then when we had our 150th anniversary with the Union Pacific, we had a sticker that had the train and the wind turbines all on the same sticker. Personally, and I'm speaking for myself now, not through Carbon County Economic Development or anything, I actually, visual impact is, some people, you don't like it, but I do. And I know a lot of people that do. They think they're beautiful. I can stand at the wind tower. I see everything in the vista around it. I can still see it. I see it all. Maybe they're up so high, and you're not going to put them next to your mountains or anything that close. You can't put them on a mountain. So I could see everything. It hasn't really impacted it, but it's personal preference. Some people may not like it. I personally like it. I think it's pretty. It looks like, that's my opinion. And I've talked to a lot of people who said they think it's their opinion as well. They like them too. So it does not affect that as far as people say their vista view. In fact, like, you can go, and actually Power Company in Wyoming put theirs back behind several hills. You can't see it from the interstate. If you want to go see it, you go drive out to it, okay? So that's my take. Don't raise any of the taxes on this. Let the economics happen. Taxes, let the county regulate whether you have a wind farm there or not. But please don't keep trying to increase the taxes. They need certainty. If you had a manufacturer or a data center want to come in and you say, okay, we're gonna have you come in, you're already getting started and go, oh, well, wait a minute, we're gonna raise the tax again on you. You think they're gonna finish up a project? They may or may not. Or others, if they hear about it, they may say, we're not gonna come because they can't afford to raise our taxes and there's no certainty. Why are you doing this to an industry that's going to end up impacting not only our county, but other counties in the state for good, for taxes and revenue increases? That's all I have.
Let me throw 2 questions at you. First, you're not advocating to take off the $1.
Leave it as is.
Okay, and the second, there's no negative impacts associated with wind development. I mean, you have people coming in, that's why we have impact payments, right, with industrial siting, and because there is some type of cost, I just want to make sure I understand your testimony, the benefits outweigh those costs in
Yes.
your mind.
Yeah, because they do pay impact to the communities in the area. Some of that is, they may have to, there's more roads to maintain. Well, that's progress, you have to have progress. You might have new people come in. Heaven forbid you get new people to move to your town. So, that's what we're all after. We're trying to grow and bring new companies and new jobs. So there might be some impact, they say crime or whatever, because you have more people. So you might have to increase your police or sheriff force. But that comes with any company that's going to be coming in. It's not just with wind industry. It could come with any large company that could come in.
Other questions for Ms. Wallace? Okay.
Mr. Chairman, thank you. Ms. Wallace, you mentioned how many employees? 300 and some?
318 if they all come in.
And Mr. Chairman,
That's just in our area.
So, Mr. Chairman, that's a different number than I had heard about the actual employment by the company. Did that also include the indirect benefits?
Ms. Wallace?
No, I added up Rocky Mountain Power, Power Company of Wyoming.
I see.
The Blue Earth Renewable, Veritas, Yola, if they're still under permitting. I added everything up. I also included, like Power Company of Wyoming, they're bringing in, there's going to be a gas plant, gas turbine plant there that will bring in another 20 to 30 people. So that includes all of them.
And Mr. Chairman, that number again was?
318.
318.
How I counted it.
Okay. And then, Mr. Chairman, did you add up all the investments, or was that just
Yes.
so?
I added up from what they presented to the Industrial Siting Council with all the investments. That also includes the 2 transmission lines. The 2 transmission lines, Gateway West and Transwest Express, but that's only maybe about $3 billion total between those 2. The rest, the $9 billion is other capital investment, and it could go up. So that's major.
Well, Mr. Chairman, I think the point I might make is you have a $12 billion investment, which is stunning. I mean, that rivals the investment of the Union Pacific Railroad when it came here. It is gigantic. It's phenomenal. And yet the employment is only 318. That's a lot of people. That's good jobs.
But that doesn't
Oh, hey,
include,
Ms. Walls, please.
oh, I'm sorry.
Try not to interrupt, Senator. Go ahead.
So I just put it kind of in perspective. I mean, it's not about defending coal, but a coal plant producing more, the Jim Venture plant would produce more probably than all these together. It depends whether they all operate all the time, but on a net basis, and that probably has 1,000 people that work for it. So it's hard to think about all this in terms of the impact.
But question though, Senator?
Well, this, sure.
Yeah, it's, Mr.
Yeah.
Senator Case Chair, I understand we can't compare ourselves in the wind industry to the coal.
Right.
And it's, you can't, it's a different company, it's a different industry, that's minerals. This is a non-mineral business. It's like apples to oranges. So I understand it. But some of we left the data companies that's coming in, but they might generate 30 or 40 jobs. But we still want them.
Senator Case, question?
So, Mr. Chairman, and just in terms of Ms. Wallace, and I get your feeling about the viewscapes and the wind towers and how important they are. I mean, people see that differently, you know.
Yes,
So,
they do.
and we have to be fair about that, because one thing about Wyoming in my own mind is it's one of the largest undisturbed areas in the continental U.S. I mean, that is an astounding thing about Wyoming. When I travel across this great country, and I go to the Midwest and I look at land that was formerly forests and now is agriculture and now has wind turbines, I don't feel quite the impact of when I stand and look at the Shirley Basin, for example, and I see darn near the exact vista that early settlers saw, the Native Americans saw thousands of years ago. And so it's a pretty big change. It's equivalent to cutting down the forests in the Midwest, in my mind. That's just me. Everybody's different, but I don't think we should try to project one onto the other. But I think we need to allow for a policy in Wyoming that respects all those points of view and does try to preserve something for future generations. That's my point. And I hope you'll accept that thinking.
I do.
They found a way to take the red blinky lights off all night long. Like I said, stars, I would like my windmills better. But turn the damn fine.
Representative Moniker, they do have now where the lights will come on within so many miles of an airplane coming by. Yeah, so they don't have to blink all night long. Yay.
Talk to my neighbors. All right. Any other questions, Ms. Wallace? Seeing none. Thank you very much, Cindy,
You're
for
welcome.
coming to Cheyenne. Anyone else before the lunch break? Hey, Rocky Mountain Power, how are you? Mr. Cox, good to see you. Welcome back to Cheyenne.
Thank you. My name is John Cox. It's Rocky Mountain Power. I'll be brief. Recognize time's short, but I would be remiss if I didn't just briefly make a comment on a couple items. One, the handout that was passed around. I know it was just an example. I know this isn't an actual proposal today, but just to reinforce the point there on.
Which handout again?
Sorry, the one pager on the electric production tax.
Thanks.
And just pointing to the line item dealing with thermal generation, so coal generation, and a $41 million increase is substantial. I do recognize there was an offset for part of that with severance tax. I appreciate that it was brought up, I believe, by Chairman Case, that there would be some difficulty in getting that. We have coal supply agreements with many of those suppliers who are paying that severance tax. So I don't know operationally how I would offset a tax that I'm not paying. I am paying it through the fuel cost, but how do I renegotiate a contract? That would need to be discussed. But even with that, a $30+ million increase to our coal plants at a time when we're trying to find ways to make them more economic, to get them to last longer, would certainly be problematic and just something that I would point out. Just another thought as well related to that. One thing that would be important to us is anything that would be pursued as a state, that it would be done on a level playing field. So one concern that we might have would be, for example, we're incentivized to keep prices low in part because our customers have other options. Whether you choose to, if you're an industrial customer, generate your own electricity through a cogen facility, or even a residential customer through a rooftop solar facility. so sometimes we pay additional public policy costs that others don't. So whether it's a franchise fee, whether it's a new electricity production tax, we would just ask that all producers be treated equally, and that there's truly a level playing field. My last comment is just, I appreciated the spreadsheet outlining the different states and sort of their policies on that. I've learned a lot. I would just point out that multiple times throughout that document, the phrase "in lieu of" was presented. And I don't know the background on all of those states, but there's one or two in which we do business. And I know one in particular, that particular tax was intended to encourage development. So the "in lieu of" was not just simply an offset, but trying to encourage development by reducing that customer or that developer's tax burden. So just as you look at other states, I would just encourage you to try to analyze what are intended as true revenue generators as opposed to perhaps encouraging development. That's my testimony.
Questions, Mr. Cox or Ms. Sweeney?
Thank you, Mr. Chairman. As a utility regulated by the Public Service Commission, are you taxed differently than, say, a private developer on wind in particular that would be under a power purchase agreement, that you have no choice on taking their power if they're under, the field is under 80 megawatts? Are you taxed different in the long run than on the other side of the scale, a power company?
Mr. Cox.
Mr. Chairman, Representative Sweeney, the tax regime is similar. The only difference would be as comparing it to like an RFP process, the must-take provision that you mentioned. But that's not dealing with taxation. That's dealing with sort of a competitive marketplace versus a must-take requirement by the federal government.
Further questions, Mr. Cox? Seeing none. Thank you. I'm sure you'll still be here this afternoon too, right? Anyone else who can't come back? Ms. Levin?
I can come back, Mr. Chairman.
Anyone else who can't come back before we take a lunch break or like severely impact their lives? All right. Then we're going to break for lunch. Let's say come back at 1:30. Is that agreeable?